Good morning. I'm Eric Askelson, co-chair of the Global Insurance Symposium. Nate, my co-chair, want to welcome you here this morning and thank you for coming to day 2 of the Insurance Symposium. As you can see, we're breaking out the fun stuff. We've got the airplane seats here today. I'm a little worried though because I get to introduce Guy, our moderator of our next panel, and he had a 20-hour travel day yesterday, so I'm a little worried about this creating some PTSD for him. So, but anyway, we'll get this started. Guy Fraker will be moderating our panel discussion on the future of our economy. Guy is with Insurance Thought Leadership, ITL. Guy has over 30 years with the insurance industry and has been on the leading edge of building innovation systems for the past 10 years, spanning primary carriers, reinsurers, and related sectors. As Chief Innovation Officer, Guy leads ITL's Innovator Studio, serving insurance companies, regulators, and reinsurance firms by helping them leverage consistent innovation for long-term leadership, growth, and stability. He coaches entrepreneurs, leveraging ITL's Innovator's Edge to launch new ventures. Prior to joining ITL, Guy served as the executive director of Create Futures, a step-by-step how-to system of innovation best practices, and also was chief learning officer of Autonomous Stuff, a provider of autonomy-enabling technologies and world-class services. So we look forward to this panel, and I'll turn it over to Guy.
Thank you. Well, good morning. Oh, come on. Good morning. This is going to be, this is exciting information, and I really appreciate the opportunity to be here. I actually love the airplane seats. Just very quickly, I was sharing with the panel. In 2008, a group of us were wondering if cars were going to continue to be cars, and as many of you know, I spent the subsequent 8 years pretty well dedicated to self-driving vehicles. And where risk and the cars intersect, bad pun. But all of that started in 2008 on a flight. I was sitting in a couple of seats like this, and this gentleman next to me popped open a laptop and put in a DVD, and it was a self-driving vehicle from Germany, terrorizing a journalist. And I introduced myself to him, and it was Bobby Hembrick from Autonomous Stuff from Morton, Illinois. This was on a flight from California to Dallas. Had the same connecting flight, and in 2012 joined Autonomous Stuff, and then we subsequently went out and created a whole bunch of fleets. I'm particularly appreciative of the opportunity to be here, and I'll introduce the panel in a second. This is my 4th year here at GIS, and I was thinking back, the very first year, the vehicles were still largely considered science fiction. And in just 4 years, the amount of venture capital going into insurtechs and into the insurance industry is significantly higher from auto manufacturers and tech giants than it is insurance companies. We're looking at nearly 40,000 early stage entrepreneurs around the world, and literally gone from millions to hundreds of millions to billions of capital going into the modernization or to the future of this industry. And so by any stretch, the change and transformation and growth in the industry dealing with breakthrough technologies has become an economy in and of itself. I've got a great panel to come up and share their thoughts. Come on up, and I'll run through real quick. We have Stephen Weisbart from the Insurance Information Institute, Chief Economist. Dr. Robin Anderson from the Principal Group, also Chief Economist on the asset management side, and someone who I've had the pleasure of sharing a stage with on several occasions, George Woods from Guy Carpenter, who, if my best description is one of the keenest eyes in the innovation and entrepreneurial scouting world, and has introduced a number of very interesting technologies into the insurance ecosystem. We'll start out with some prepared questions. Hopefully nobody will take a nap on takeoff. We'll start out with some prepared questions, but I believe the information is on the screen or going to be to text questions, because of the acoustics in here, we'll be texting questions in. We encourage you to jump in early. And that has never been a problem here with this event. So we'll take your questions and as soon as they start coming in. So just to open this up for the panel, you know, the industries, depending on whether you're a pessimist or an optimist, the industry is either being disrupted or is just loaded with opportunity. And as you have the opportunity to make a couple of opening comments, I'd like to also hear kind of what excites you the most about the future of the economics of insurance, or what keeps you up at night. And Steve, I'll start with you.
I think what keeps me up at night, I'll take the second one first, Guy, that is the, what some are calling the protection gap. The opportunity for the industry to serve better if people were willing and arguably able to buy the insurance that will serve them better when bad things happen. The industry gets blamed frequently when the payments for claims are not sufficient to repair all the damage that's occurred. And maybe some of it is the industry's fault, but I think largely what we're confronted with is what economists call the behavioral economics problem. People are not behaving as rationally as Econ 101 would want us to believe, and in those non-rational choices, failing to position themselves to better handle the bad things that occasionally happen. In terms of what gets me excited, I think the advent of virtual reality in service to the insurance industry. I think one of the things, millennials are supposed to be oriented towards experiences rather than buying and owning things. And I think virtual reality, the little I know about it, since I am not a millennial, is promising in that I think what we can do if the insurance industry harnesses it is to put people in a situation where they can virtually experience a claim and understand how insurance performs in that circumstance. Right now, I think without that experience, virtual as it may be, many people deny that they're going to be affected at all and choose not to buy insurance. Flood insurance is the classic example. So many don't even buy it or buy so little. If they really understood what the odds were, what the experience is like, how insurance can help, and I think virtual reality can make a major contribution to that, I think we'd see a tremendous upsurge in purchasing of insurance and when the time comes to make the world a better place when claim payments are made.
Great. Robin?
Sure, I'll take a little bit of a macro perspective. I'll start with what excites me, so I'll reverse it up a little bit. I think labor markets in developed market countries are the best in decades. A few months ago, the US unemployment rate dropped to the lowest level since 1969. Jobless claims are the lowest since the late 1960s. The Eurozone unemployment rate is the best in a decade. Japan's unemployment rate is the best since the mid-1990s. Despite Brexit, the UK unemployment rate is the best since the 1970s. And with this declining unemployment rate, we're finally seeing for the first time in this expansion some wage growth. And without a lot of inflation pressures, that's translating into boosts to real household income. And at least in the US, wage growth is actually happening at the bottom of the income distribution. I guess what keeps me up at night, I get concerned about when the next downturn happens. I don't think the next downturn will happen for a while, but when it happens, I'm not sure if policymakers have the tools to do what's needed. Will Congress and the president be able to work together to provide fiscal stimulus for the US economy when there's a recession? Europe in the last downturn went down the path of austerity, not fiscal stimulus. And I'm not sure how they'll be able to agree on fiscal stimulus in the next downturn. And I'm concerned about whether or not central banks with ultra low interest rates, negative interest rates in Europe in particular, will they have the firepower to deal with the next downturn?
George?
Oh, what keeps me up at night is, Guy Carpenter, we're a reinsurance brokerage firm. Our clients are insurance companies. One of the things that I look at is when you look at some of the regional insurance companies that are out there, and with the emerging technology that you see, some of these companies don't have an idea of where to start, how to integrate the technology into their present operating model. And the challenge I see there is that these companies are the pillars of their community. And with competition continuing to increase, where you have larger carriers, have the size and scale, looking at ways to penetrate that marketplace, there's an opportunity for these larger carriers to cherry pick sort of the best customers and what have you. And so, my concern there is what's going to happen to both the regional carrier as well as the independent agency distribution channel.
I have just share a quick perspective on some of this as a setup for the next question, because as people I work with know, I'm incredibly optimistic and passionate about the future of the industry, because there have been multiple periods throughout history where a breakthrough came and it would have stalled had it not been for mavericks in the risk-taking and risk management industry. The car going viral happened because a bunch of mavericks started a new auto insurance industry with no data. And the breakthrough technology was mass manufacturing. And you can go all the way back to the formation of the country and how property ownership was enabled by the first homeowners insurance company or property insurance company that was funded by the Lloyd Syndicate. And time again, society has been propelled forward with economic stability when the insurance industry has embraced the opportunities of breakthrough. And so all of this innovation is really in the DNA of the industry. And this is just such a tremendous time for companies, regardless of size, to chart a different course or an expanded course. Once they figure out that starting line. George, we'll start at the other end and work our way back. Recently, CEO of Lemonade, Daniel Schreiber, said that insurtech firms were better, this is a great quote, were better at the art and science of underwriting risk than traditional carriers, which is a pretty bold statement. They also recently, as you know, raised an additional $300 million for expansion, predominantly into Europe. I'd like to just kind of get your reaction and thoughts to that bold statement from Daniel.
Well, I think they've been making bold statements since they started. And if you look at their results, the results speak for themselves in terms of, I think, the Q4 last year, they had a 116, somewhere in the hundreds in terms of loss ratio. But I don't want to say bash Lemonade because of the fact that there's some things that I think that they're doing that are very interesting. There are also things that they're doing that are forcing a number of other carriers to take a look at their model. And when you think about the fact that they've raised this $300 million, and they're talking about expanding into Europe. I know last year I had the opportunity to interview the chief underwriting officer in June of last year, and he talked about this is the target they're going after. They want to expand to Europe because they find that there's similarities between renters and homeowners in the US as well as in Europe. And a number of their customers are millennials, as well as a number of their customers are those individuals that are downsizing. And so he felt that demographic had basically similar characteristics. Now, what remains to be seen is the fact that they're expanding globally needs to be watched, because when you think about it, there is a digitally driven business model where they've been able to expand to different states without having to scale up. You know, typical insurance company, if they want to go into a new state, usually they have to identify agents, brokers, they have to identify people in that geographic area that they need to hire, so forth and so on. Not the case. So if they're able to expand in various states within the US and do it digitally without having to scale up, that model could possibly work globally. And pretty much in terms of being tied to customs or hiring local talent in those countries, may not have to do that. So where I don't agree with the statement that insurtechs know how to pretty much write insurance better than existing carriers, I do think that they've got a couple of things they've done pretty well in terms of, anybody here have Lemonade insurance at all? Well, I tried buying Lemonade insurance, the premium was too high. But one of the things I found is it was easy to actually get a quote. Mm-hmm. The customer experience was very, very simple. It's on mobile platforms. So I think they've done a number of things that are very interesting. Companies should watch and see what makes sense and possibly adapt.
Great. Either want to do you have additional comments about Lemonade or that model you'd like to weigh in on?
The only comment I'd make, guys, is they're obviously faster than anybody else, basically getting the job done. That we all know. That doesn't necessarily translate into good. But one of the things they seem to believe very strongly is that people are very impatient, and that if you deliver something quickly, they'll take it whether it's really good for them or not. And we'll find out, I guess, at some point if that's a correct assumption. I tend to be a little pessimistic about it, but nonetheless, I think that's part of their operating DNA.
Well, it's an interesting, you mentioned behavioral economics. It's an interesting behavioral economics question because traditionally, consumer empathy was holding somebody's hand for 2 or 3 days or a week while a claim got processed. Is it more empathetic to pay someone in minutes? And that's a direct frontal assault almost on the traditional business model. Robin, as you mentioned, this U.S. expansion in the economy has certainly benefited the industry, and the industry is certainly intertwined in participating in that expansion. You mentioned downturn probably not being likely in the near future, but more specifically, what are your thoughts about downturn or growth over the next 2 years?
Yeah, sure. So I actually, so this expansion, I think in June of this year, it'll end up being the longest on record. And I think it'll actually persist a little while longer. I don't think recession risk really is a problem until probably 2021. There just aren't a lot of imbalances building up in the US economy right now to signal recession. Households, the biggest part of the US economy, their balance sheets are actually in fine shape, despite what you've heard about student loans or credit card debt or subprime autos. Household debt to GDP, household debt to personal income has been declining since the end of the financial crisis. Household financial obligations ratios, so this is how much people pay in terms of debt payments compared to their personal income, is at a near record low because of ultra low interest rates. Corporate debt in the US is up, but if you compare corporate debt to GDP in the US to other countries in Europe and Japan, we're actually in pretty good shape. And the US economy, despite, as I talked about earlier, the unemployment rate being really the lowest since the late 1960s, we're still not at full employment yet. If you look at the labor force participation rate for prime age workers, those workers 25 to 54 years old, it declined since the end of the financial crisis, and a couple years ago it started to pick up, but it's still well below the highs we've seen in prior expansions. So I still think there's room for the labor force participation rate to pick up for prime age workers. I think that's going to happen, particularly with a little bit more wage growth. Productivity growth, which had collapsed after the financial crisis, productivity growth is one of the building blocks of GDP growth, over the last few quarters has shown some tentative signs of picking up. And that could boost the potential growth rate of the US economy, so how quickly the US economy can grow without inflation pressures, and that could potentially extend the cycle. We have our own proprietary recession indicator. Right now, so look at 19 business, employment, consumer, and financial indicators. Right now, only 3 of those indicators are signaling recession. The 6-month change in stock prices, average hourly earnings, and oil prices. And I anticipate in a little bit, only 2 will signal recession. So right now, we just don't see a lot of recession risk, and I think that would be continue to benefit the industry at least a couple more years.
Great, thanks. Stephen, we know that the insurance industry plays a huge role in the economy in addition or besides paying wages and paying claims and kind of keeping money flow. I know the Insurance Information Institute recently published a paper on how insurance drives economic growth, which I found particularly interesting. As we talked about earlier, I spent most of December working with insurance CEOs in Central and Western Africa, where the penetration of products is 0.005% per household. And it's really an industry almost back at the turn of the century in terms of both growth and stabilizing those economies. Can you outline what are the roles the paper identified for the industry in economic expansion and stability?
Sure. I think we're really familiar with many of these. We heard some of them mentioned yesterday in a number of the presentations, but let me just quickly run through them as we were able to identify them in the paper that got referred to. The first one is that insurance claims adjusters, agents, and so forth are what we call financial first responders. After the fire is out, after the initial destruction has taken place, the first people on the scene, generally speaking, are from insurance companies. And not only are they there quickly, which is really important to the concept of resilience. You can build faster if you have resources available faster. And so we are able to provide them pretty much faster than any other source, especially compared with help from governments. Government aid is, generally speaking, quite uncertain, both in amount and timing, which is of cold comfort to the people who just had some real major problem that they have to respond to. And if you look at what happened, for example, in the California wildfires, people whose homes have been burnt to the ground, whose towns have been burnt to the ground, what some insurance agents found over there was that agents became essentially psychologists for the policyholders. The people who had nowhere else to go to talk about what had happened to them and were expecting claims payouts also felt comfortable talking with the agent with whom they had a good relationship as a way of working through what had just happened to them. So there's a couple of major functions tied to the first responder dimension, I think, that insurance provides. Secondly, insurance is very deeply into risk reduction, risk mitigation. And who do you think is funding the Insurance Institute for Highway Safety? Who's funding the Institute for Business and Home Safety? Who's funding, you go back far enough, Underwriters Laboratories? It's the insurance industry is looking for ways, doing research to lessen the kinds of bad things that happen in our lives. You don't see other industries essentially at that level undertaking those activities. Third point, the insurance industry, particularly coming off the great financial crisis of 2008, 2009, is a much more stable contributor to our financial stability system than the banks. The banks, there were over 150 banks that failed in the Great Recession. There were 10 insurance companies that became, according to AM Best, impaired, not failed. And the biggest one, obviously, is AIG, came back to health, repaid the government, and is back again competing aggressively against the companies that it competed with before the Great Recession. So the stability of the financial system in the U.S. is something the insurance industry is the backbone of, really much more so essentially than the banking system. The industry is a major contributor to various forms of social policy. Back 100 years ago, when the automobile was just getting going. We were worried that people who drove these things might run into other people or other property and cause damage, and so the states enacted financial responsibility laws. If you're going to drive, you should be able to pay for the damage you caused. The way that that was basically put into effect was to mandate the purchase of auto insurance. And what that did is, I'll skip down to another of the benefits of the insurance industry in our economy. What that did was, instead of your having to set aside in a savings account $10,000 or $20,000 to compensate people you might hurt, you buy an insurance policy for a couple of $100s a year, and you don't have to set aside that personal savings money. You can use that for all sorts of other things more productively. So not only do we have the benefit of people being protected against damage that others cause with an automobile, but we also have a very cost-effective way of engineering that through the auto insurance industry. We can talk about buying insurance against things that happen to your particular bricks and mortar business, but these days the vast majority of businesses are run on a long-term supply chain. Many things that you need, you get from far away, and it's impossible to know what's going on over there, wherever there is, whether it's across the country or around the world. But you can buy insurance to deal with those kinds of things so that your business is much less interrupted when those kinds of things happen in places you don't even really know exactly where they are. And so the stability of your own operation as a microeconomic phenomenon is assured and greatly supported. One of the obvious things, obviously, we collect money in premiums. We don't pay them out instantly in claims, and so what we do is invest the money in the meantime. Sometimes we don't realize quite what we're talking about. Between the life and property and health insurance industries, something on the order of $4 trillion in bonds are purchased by the insurance industry. If you throw in the reinsurance industry, it's like $5 trillion in bonds, with a tremendous value that it has for a market that is now much more liquid as a result of the insurance industry's participation, and put to extraordinarily productive uses. If there are projects to build major projects, like this building, for example, the risks involved in doing this would be beyond any entity that we can think of, except maybe the US federal government, and even that's not interested in accepting risks of that magnitude any day. So what you need is insurance to protect against bad things in the process of constructing and operating this building. Insurance makes that possible, so we have this marvelous place to be meeting. We talk about innovation a lot, and one of the things that Guy mentioned is that innovation, pretty much going back to or even beyond, historically beyond Lloyd's cafeteria, coffee house. The insurance industry has always been a major supporter of innovation. These days, if you're Elon Musk or Jeff Bezos and you've got some rockets you want to fire off, the Federal Aviation Administration ensures that you will not hurt anybody because it requires you to buy liability insurance. And won't let you lift your rocket off the launch pad unless you can demonstrate that you've got coverage for damage that you may cause to other people's property or their lives. And finally, banks and other lenders are much more willing to lend if they think they're actually going to get repaid. And one of the benefits of having the insurance industry operate is that people know who lend money that with insurance as a required element of the transaction, the chances of the loan being repaid are much higher. So those are some of the things that insurance does. I think, as I said, we're all pretty familiar with them. But when you put them all together, I think it's a really massive support for our economic system and for economic growth.
Thank you. And all, I think, incredibly important points. I'm going to turn the conversation a little bit more with a forward focus, with just a couple of stats you may be interested in. Over the past 3 years, roughly 3 to 4 times the amount of capital that's gone into insurtechs has gone into technologies targeting the cannibalization of losses. actually preventing the loss from occurring in the first place. Not just in P&C. And I realize now you start to be on the fringe of science fiction. But life, health, disability, all lines. And that number, that differential, is growing exponentially every year. The second number I think is fascinating is that last year, 17% of all venture capital that went into new technologies, specifically within InsurTech, came from named, branded venture capital arms associated with the insurance industry. 24% of the money that went into InsurTechs came from auto manufacturers. Lamborghini, Jaguar Group has closed over 105 venture transactions in the past 30 months in InsurTech. In speaking and work, so you've got, and then the majority of the insurance venture capital money is going through professional fund managers, which means the insurance industry money is investing in InsurTechs with the barbarians at the gate. Right? Average venture capital deal has 5 investors, and these include tech giants, auto manufacturers, other institutional investors, and, oh, by the way, the insurance industry. And so the InsurTech movement's actually enabled new entrants and expanded the potential base of those providing these products. So with that with that backdrop and this phenomenal amount of capital that's kind of flowing through, if I put out a hypothesis that said the 2 biggest targets at the center of the bullseye of the existing industry are the float, the difference between earned premium and paid premium, that companies like Trove and Lemonade and on-demand insurance basically attack that differential. And the second being just being able to process everything so much more efficiently and more timely without the legacy system. How do you see the influence? And George will start down at your end, but how do you see the influence of all of these external players that are now capitalizing change in the industry, and including the prevention of losses, affecting, or how do you see the insurance industry responding to these influences and trends?
Yeah, I think when you think about all the capital that's flowing into InsurTechs, for example, and I'll cite some numbers that I saw CB Insights put out some information where if you look at Q1 2018, approximately $700 million was invested in InsurTechs, and you look at Q1 2019, it's up to approximately like $1.4 billion.
Wait a minute, could you repeat those numbers?
What's that?
Could you repeat those numbers again?
700 million in Q1 2018, and in Q1 2019 it was approximately like 1.4 billion being invested in InsurTechs. And so, one of the things that I see when I talk to startups, I talk to insurance carriers, I see opportunity. I see opportunity that's beneficial, especially to the consumer. So, for example, you talked about claims. There's opportunities now to integrate new technology, imagery, text messaging to try and improve that claims process so the consumer is made whole a lot faster. There's also opportunity to take a lot of the data that's out there and begin to more accurately price your risk and exposure. One of the big things that I see that's a possibility going forward is what we hear about on-demand insurance, where right. if I have a family and I have car insurance and I happen to have teenagers in my home, today when they become of age or eligible to drive, my insurance premium goes up automatically. Well, with on-demand insurance, maybe there's a way now, instead of it going up automatically, it only pay for when my teenager that's of age that drives my vehicle for the time that they drive it. And you have the technology there that can make that happen. So, so I think the benefit of all this is this technology is actually a catalyst to continue to help change insurance carriers. And you know, I know a lot of the tech firms think insurance companies are not innovative. That's not true at all. I think when you look at the fact that here's a company, an insurance carrier in particular, they're saying, hey, give us your risk. You know, anything that happens bad, we'll make you whole again. To me, that takes a lot of innovation to figure out how to do that profitably. And so I think there's a tremendous amount of opportunity for insurance carriers to improve their results, as well as improve the customer journey that most individuals are having with insurance companies today.
So with all of this, Robin, with all of this deal flow and this tremendous amount of entrepreneurial activity, how do you think that that's a significant role in some of the labor numbers that you were referring to in the continuation of this expansion?
So I think if you look at the labor numbers, I think what's really interesting is what's happening, and I think this will be important for potential ongoing new customers within the insurance industry. I think it's the number of people rejoin the labor force and the wage growth that's happening at the bottom of the income distribution that I think will continue to benefit and allow this expansion to continue.
Stephen, comment about either from a labor force perspective or just how these technologies, particularly as you get into fewer losses and more on demand, what effect that could have on some of the bonds or long-term investment portfolio practices.
Well, let me answer that partly, Guy, by talking about some of the other changes that I think are related to that. We hear a lot, have been hearing a lot for a while about the Internet of Things. And one aspect of home ownership and home building that we don't hear a lot about is home renovation. That's been going along pretty strong too, actually. A lot of people staying where they are instead of moving to other houses that might suit them better. They're willing to stay where they are and change things to better suit their present circumstances. And when you do that, in today's age, you can, at least on some level, add sensors and detectors and elements that would identify problems ideally before they get too big, or maybe even before they happen at all. And to the degree that these things are in place, are validated, insurance companies may offer premium discounts because obviously of the effect that they would have on loss ratios. So one of the things that, to get back to the question about investments and bonds, and this is obviously a long story of the investment markets, is that when progress is made, you see changes from some industries to other industries, but you basically see growth continually all the time. Our population is expanding. The number of people who are going to be alive and lead longer lives is expanding, as we heard yesterday from the Limber CEO. And so I think what you're looking at is continued development of the bond markets and even the equity markets in the direction of some of these new changes that I just made reference to. Right. I think there's opportunities there. It's just that they're not necessarily in the same places that they have been in the past.
Guy, we've
questions coming in?
Yeah, we've got some great questions that have been coming in, and I apologize, we're not going to be able to get them all answered, but want to get a few of these to the panelists to comment on. So there's a question from, I'm going to give you two of these. So there's a question about if you're prognosticating about when the downturn hits, what do you think are going to be the precipitating factors that cause it? So that's question one. And then related, if you're looking at incumbent large insurers versus startup insurers that are new to the market, how do you envision or see them riding through through that downturn. So there's a couple. So if we have time, we'll give some more.
I'll start with the first
Yes.
one. And then, so I think the next downturn, so I don't think so. The 2008 financial crisis came from housing, it came from consumer debt. Household balance sheets are in pretty good shape right now, as I talked about earlier, so I don't think the next downturn will come from the consumer. I'm actually more concerned about things happening outside of the US. We had a mini downturn in 2015 and 2016. If you remember, gas prices got really low, which was great for the US consumer, but it was really bad for the US industrial sector. In fact, the US industrial sector, with its larger share being devoted to energy, actually fell into, we had a mini recession in the US in 2015 and 2016, and this came from external factors. It came from slowing global growth, slowing commodity prices, slowing energy prices. And I think the concern for the next downturn is, will it come from outside the US? Will we see something like the 2015, 2016 downturn, except more broadly? I'll stop there and see.
George?
Yeah.
Steve, go ahead.
I was just going to add one thing to what Robin said, and that is that what she described as a mini downturn, one of the things that people tend to associate with the idea of a recession is actually negative GDP. 2 successive quarters of downturns in GDP. We didn't have that in 2015, 2016. What we had was a very, very, very low growth rate in the below 1% for an annual rate for a couple of quarters. And I think that there are more economists forecasting that type of behavior in the coming, say, year, 2 or 3, rather than actually negative growth. Whether we will consider that a recession is partly up to the National Bureau of Economic Research. But so if it's really, really slow growth, that may be effectively the equivalent of what we loosely talk about as a recession. The second point is that one of the big debates in terms of monetary policy these days is whether, with interest rates as low as they are, the Federal Reserve has any substantial weapons with which to fight any slow growth that develops. One of the reasons why arguably the Fed was raising rates for most of the past 2 years was so that it could basically find some bullets to put in its gun to fire when and if we had a recession. They've obviously suspended raising rates, and now it doesn't look like they're going to have another increase in maybe another year. But they've stopped at a point where even if they wanted to lower rates, they really can't lower them very much to get to zero. So if they don't have much in the way of weapons to fight a slowdown or a recession, not only might we have one in the coming years, but it might last a while. So.
No, I wanted to see if there are more questions.
I think your observations on the large incumbents versus the startups in the next downturn.
Yeah, I'll kick that one off in that, AM Best recently announced the assessment criteria for innovation, a project that was, and an effort that I'm an enormous fan of because I think it's a tremendous service to the incumbent industry as kind of a heads up. No industry that's been disrupted by technology has ever had an organization step up in advance during this significant window of opportunity to hedge and protect against it. I think using a systematic and innovation, a systematic approach to innovation and best practices is an absolute hedge against both competitive pressures from new entrants or from outside the country, new entrants who see the American insurance industry as a growth market, as well as a hedge against the downturn. What I find very interesting in the work I do with insurers who are taking on a systematic approach is a very basic question often gets missed, which is, if you are going to engage in venture capital work, if you're going to engage in the process of invention, or you're going to engage in the process of expanding through partnerships, what are you going to do with the capital? And I find that that's where the real you see a company's level of confidence when they don't expect any returns early on, which the returns are going to be there. So designating that growth, designating those returns for continued expansion, I think is a significant strategy tip, but also another hedge against the downturn. And George, I know you spend a lot of time out in Silicon Valley and around entrepreneurial hubs where incumbent companies are testing the waters or have scouts around. How would you respond to that question?
Yeah, spending time out there, and I spent 20 years on the carrier side. I know whenever during that 20-year period, I've seen the hard market. I've also seen the downturn. And usually the behavior that I've seen is, for an incumbent, for example, is when there's a downturn in the marketplace, there begins to be, especially your standard lines carrier, you're starting to look at how can you continue to keep your top line growing. And so in some cases what happens is they tend to begin to write risk they wouldn't normally write. So a risk that would normally go into the E&S marketplace, standard line carriers start to begin to target that and try to write that business. So I think the behavior will change, and it's a matter of how do you continue to sustain your top line. In terms of insurtechs or new emerging technology firms, I don't have experience with that, but my thought would be that it'd be a challenge because a lot of these startup tech firms today are partnering with insurance carriers. And so their funding is coming from a number of these insurance carriers. So my initial theory or thought would be that I would probably think that insurtechs would be basically in a position where, depending on what value they're bringing to that insurance carrier that's investing in them, if they're not helping them grow their top line or reduce their expenses, or they're in the proof of concept phase, then their funding could dry up, is one of the things I see. And then two, you have a lot of private equity VC firms that are investing in these startup technology companies. They'll probably go to another industry or look at technology firms that can give them that return they're looking for, because they're always looking for the next unicorn.
And let me share something I ran into in Australia and South Africa, where incumbent companies saw tremendous pressures and there's much less economic stability. They would take an idea or the kernel of an idea and launch a separate branded monoline company off-brand from the parent brand. And two companies I would recommend that you take a look at, Telesure from Johannesburg, who's launched 7 in the past 8 years. And another very interesting one is Hollard in Australia, that decided there's minimal risk to shock loss in pet insurance. So they launched a pet insurer, and then they launched a second, and then they launched a third, and then they launched a fourth. So any cannibalization all stays in the family. They have 85% of the market and have been able to use all 4 of these as different sandboxes to test products and services and partnerships and networks. It's a fascinating model. It's in use a little bit here in the United States, but not like a primary growth strategy, where it has been in some of these other countries. Additional question?
We've only got about 5 minutes left, so why don't we let you kind of round it out with the panel, and then we'll let you break it, the group for our break. So about 5 minutes and close it out. Thank you.
Sure. I think that, again, in looking back over my experiences with what is arguably easily one of the top favorite conferences that takes place every year, I think about all these changes. I guess a wrap-up question I'd like to pose to the panel for your thoughts is, what do you think are some of the biggest surprises that have, or learnings that have occurred over the past 4 years as in your involvement in the industry? And what do you think we'll be talking about 4 years from now? Either one. Pick either one. Robin, do you want to go first?
Yeah, sure, I can start. So I think one thing that definitely matters on the investment side for the insurance industry are interest rates. And interest rates have been extremely low since the end of the financial crisis. But I think we're moving from a period of deflation and low interest rates to a period when we see a little bit more inflation and a little bit higher interest rates. Higher wages in China mean the deflationary impacts of globalization have ended. Wages, as I've talked about, have finally picked up in key developed markets, and eventually those wages should translate into higher inflation. And the Fed has signaled that's going to be willing to be more tolerant of higher inflation going forward, and that should hopefully boost inflation expectations, a big driver of interest rates. So I think the insurance industry will probably get a little bit of relief in the next few years as interest rates finally start to move up, as we finally see little bit more inflation.
Stephen, what are your biggest surprises or lessons learned over the past 4 years, or what do you think we'll be talking about 4 years from now?
Not to undermine what Robin has been telling you about economics, but I think to me one of the biggest surprises is that economists now know that they know less than they did 4 years ago. I mean, we expected that when unemployment was as low as it is, that inflation would be rising quite substantially. It hasn't been. In fact, if anything, it's lower, depending on which measure you use, than we expected. So clearly, we have no idea what's driving inflation, or whether, in fact, we're even measuring unemployment properly, given the growth of the so-called gig economy and other factors that are going on. And there are a number of other, we really don't know why I guess you call it the expansion off of the 2008-2009 contraction, why that's still going as strong as it is. The growth in the labor market, as Robin suggested, is very strong. Nobody seems to have a clue as to why we're so fortunate that more people have jobs now, that by lots, actually, 2 million or more in a year. We're happy that that's the case, but if you ask for explanations, you get a lot of shoulder shrugs. So, and we thought 4 years ago we had it all figured out. So those are among the surprises, I think, that disappointing surprises that we're looking at.
George?
Yeah, I would say 4 years ago, maybe even a little longer, when you'd have conversations with insurance carriers, especially in the C-suite, their concern was emerging technology and how they're going to be disrupted. And fast forward 4 years later, those same companies are now saying, well, we don't look at ourselves being disrupted. We're partnering with these insurtech firms to try and help us improve our processes and what we offer our customers. However, there's still, 4 years from now, what I wonder is, I think disruption can still happen. And it may not be an insurance company. And it could be, a Google, or it could be an Amazon. And to me, that's sort of the big question mark for years down the road. What company can actually be large enough, have the technology that could actually disrupt the existing insurance carrier business model?
Great. As a moderator, we all show our appreciation for the panel for sharing their expertise this morning. Thank you so much. And if all of our contact information I know is in the briefing book. If there are additional questions, I know everybody's open to responding to those as well. And with that, we'll turn it over.
Thank you for moderating the panel, Guy. We appreciate it. We're going to take a 5-minute break, so refresh your coffees. We're going to get the stage set up for Susan Neely with ACLI. So we'll take a quick one here and then come back in, and we'll start the next presentation. Thank you.
Okay.
check.
All right, we're going to keep the show rolling. What a way to start the day with a panel on economists. I don't know about you all, but I was comforted to know that they're not just sitting in their offices shaking their magic 8-ball, finding out the answers that way. Our next speaker is Susan Neely, the president and CEO of the American Council of Life Insurers, the nation's leading trade association dedicated to providing products and services that contribute to Americans' financial and retirement security. As president and CEO, she drives public policy and advocacy on behalf of ACLI's member companies that represent 95% of the industry assets and serve 90 million families. She's been very busy in Washington. She served as special assistant to President George W. Bush, senior advisor to 2 members of Congress, as well as Governor Terry Branstad, Iowa's former governor. As a matter of fact, she spent so much time here. Tuesday night, I heard her referring to, when talking to Iowa, as we. So I think deep in her heart, she's an Iowan, and she's here this morning to share some of her thoughts with us. Please welcome Susan Neely.
Well, thank you, Nate. Yes, it is forever we. You can take the girl out of Iowa, but you can't take the Iowa out of the girl, and I think that's a really, really good thing. Congratulations to you and Eric and Commissioner Oman on this excellent symposium in the home stretch here. And my first opportunity to be here, and I've been very impressed with how you put such great content together and really make this a powerful opportunity for all the leaders in the insurance industry to get together and talk about the issues that are facing us and where the opportunities and challenges are. So congratulations to all of you. I am very happy to be back in my home state. I'm an Iowa City girl, a graduate of the University of Iowa, and did live in Des Moines for a number of years and had really enjoyed the opportunity to get back periodically and always see how this city is thriving and growing. And I'll tell you my real Iowa moment, though, when I knew I was back home, was yesterday morning when I was out early walking. It was probably 6:15 in the morning. At least 3 people on the street, including one who looked like he was a little down on his luck. Don't know if he was homeless, but definitely not feeling well. So 3 people at 6:15 in the morning, as I passed him on the street, said to me, "Good morning, I hope you have a nice day." And for anybody from the East, that would have been they would have been totally flummoxed by that, actually. I talked to a lot of political reporters and political operatives on both sides of the aisle who've been in and out of Iowa and Des Moines over the years, and they're always flummoxed by that side of us that's seriously nice, no matter what your vantage point is life. And so at that moment yesterday, I knew I was home, and it felt really good. Well, it is a kind of a circle of life moment for me to be here with you at this moment. As Nate said, I did early in my career in the 80s, worked with Governor Branstad and was a senior aide to him really from the moment he was elected the first time. And it was shortly after Election Day in the 80s when he was first elected that the bottom dropped out of the farm economy. Land values plummeted 63%. So we all know what that means in a state that depends on agriculture for its economic health. That's not a good thing. Farmers were losing century-old farms. Iowa actually went from 200,000 family farms to 98,000 farms, and the trickle-down effect was unforgiving. In that first term that the governor was in office, we closed dozens of banks for insolvency. When farmers are losing their land, when banks are closing, there aren't enough people in the town to keep the school going. We were closing schools, and towns were dying. It was truly, as we called it at the time, a farm crisis. And I remember walking through lines of picketing farmers on the way into the office in the Capitol building, farmers who were just desperate for help. And those of us who were born and raised here saw friends and family struggling with what to do. It was really a difficult time in the state's history. So as governor, Branstad knew he was the first responder to the crisis, had to figure out how to provide immediate relief to families, but we also needed to create a new, diversified environment for the state's economy. There was no way that this could happen overnight, but we made an intentional decision to lead and to make Iowa an economic powerhouse. So what do you do when you're putting a strategy together in business or in a state? You play to your strengths. We knew Iowa was a great place for insurance. Our laws were friendly, and we had a highly educated workforce. Of course, Principal Financial Group, along with many others, were already major players here. So we took steps to attract more interest in this insurance space. We worked the vision every day in those early years of Brandstad's tenure. Of course, the strategy succeeded. Iowa pulled itself out of the quagmire we were in. We reversed the downward spiral, and here we are today. So I'm really enjoying this circle of life moment on many levels. It's such a privilege to be speaking to you 30 years later now, representing the life insurance industry as the CEO of ACLI. At a global gathering of insurance companies in this great state of Iowa, an insurance hub for not just the Midwest, but the whole world. I've thought about that moment in my career many times. It was truly a success story for Iowa. But why was it so successful? I think it comes down to two reasons. First, Governor Branstad started from a place of deep empathy. He was raised on a century-old farm. He knew farmers, and he knew Iowans. Iowa is a bedrock of strong work ethic, and the farm crisis felt like a punch in the gut to that work ethic. But second, he connected that empathy with smart economic strategy. As a team, we worked the mission. We knew Iowa's strengths, that we had legitimacy in the insurance sector and a proper workforce, smart, well-educated, bred in the bone work ethic, and we played to those strengths, and it worked. Today, in business as in government, we often start by asking, what can we do for the customer constituent? We focus on things like business factors and economic viability, both critically important because they are existential qualities. But what if we first started from a place of empathy, never forgetting we are serving real people? And what if we connected those human factors to our business strengths? That's what I'd like to talk about today and consider along with you as we are gathered here representing the insurance industry during such a dynamic time. We are in an era of rapid continuous change where old models are being turned upside down, completely upside down continuously, or as it's popularly known, disruption. How many conferences have we all been to on disruption? I actually think my talk about leadership in the policy space and how we're navigating that disruption is sort of a natural bookend to what Dave Levinson talked about yesterday in terms of marketplace opportunities. But opportunities you can only see if you look through a different lens, ask different questions, maybe look deeper at where the marketplace opportunities are. I think the same is true in the policy space as we look for ways to make an impact and lead. So it's easy in this period of disruption to ask the question, what can we do to keep up? But if we start from a place of empathy, the real question, or the question changes, I think. It's, what do people need from us? How can we think with society, be allies or partners with policymakers, and lead using this industry's unique strengths? Today, I want to focus on 3 things that I believe people are searching for today and how they are connected to the work this industry does. First, people want to close the financial gaps in their lives. Second, people want to care for their families. And third, people want to feel that financial peace of mind is accessible and achievable. So let me start with the financial gap. What does that mean? Well, people think about financial gaps in many different ways. It could be an income gap or a retirement gap or a pay gap or a savings gap. The gap is a metaphor. But let's consider for a moment what that gap means for people. For people, that gap represents the barrier to a dream or a healthier, more secure financial life. It represents a point of stress in their marriage or the feeling of falling short when it comes to providing for an aging parent. For some communities, particularly economically disadvantaged communities, the gap may feel insurmountable, like something that will never close. In particular, closing the savings gap is a big need, and it's becoming an even bigger need as society evolves. The way Americans work and how we live is changing. For starters, Americans are living longer. Some Americans could expect to live 30 years in retirement. The first generation of workers who largely have self-funded for retirement is nearing the age when they will start drawing down on their savings. We face a big question. Are Americans saving enough? There are 16 million workers in the gig economy. Many of these independent contractors work for small employers who don't know where to start to offer 401ks or any kind of retirement savings option for their employees, even though they may want to. Social Security faces its own challenges. The surge of retiring baby boomers, the lack of young people to support them, and people living longer put stress on the program. We've all heard the statistics. 10,000 baby boomers a day are turning 65 over the next decade. 1/3 of those baby boomers have between $0 and $25,000 in savings. $0 and $25,000 in savings, and they're likely to live longer than their parents or grandparents. Millennials are deeply worried about their financial and retirement security. Many who are bearing the heavy debt burden of student loans don't feel they are in a position to start saving. They are right to worry. In just 15 years, the government is slated to notify Social Security recipients of a 21% reduction across the board in benefits. If we don't begin addressing the savings gap now, we will be left playing catch-up with American families bearing the burden. This is a topic the world over. You will hear Commissioner Oman and other state insurance commissioners talk about the retirement savings gap. We've had the opportunity, the leadership of ACLI had the opportunity to meet with Commissioner Oman and other leaders of NAIC a few months ago. We said, what's on your mind? What's your biggest concern? And they said, regulators the world over are talking about the retirement savings gap. You will hear Chairman Grassley talk about it as a priority of his as chairman of the Finance Committee. It's not just an American issue, it's a worldwide issue. The G20, the group that represents the 20 major economies around the world, has marked aging society as one of its priority issues. It's something that policy leaders, regulators are grappling with, and we have knowledge to bear and can be very, very helpful. This is an issue where human needs and the strength of our industry intersect. We have private sector solutions that help people deal with the most important concerns in their lives, but we need to be forward-leaning. We can be a problem solver, a global problem solver, by embracing bold policies that we know will work, and we can start by tapping into the wisdom of our industry. Behavioral economists and actuaries are deeply in tune with consumers, understanding what they need and how they think. Behavioral economists for years have studied how nudging people through choice architecture can shape better public policy, and specifically, they have looked at automatic enrollment in retirement savings plans. They tell us it is the perfect nudge to get Americans to save. In fact, it increases savings astronomically. With auto-enrollment, participants join sooner, and very few people drop out after they are enrolled. We know this. And so this year, our industry announced a bold shift. We endorsed a federal proposal by House Ways and Means Committee Chairman Richie Neal that would require employers to provide workers access to automatic payroll deduction savings through an IRA, 401k, or other qualified retirement plan. A requirement like this would provide access to 30 million more Americans, access to retirement savings to 30 million more Americans. It's a number equal to 10 times the population of the state of Iowa. And this is the kind of model we need to lean into to begin to close the savings gap in our country. We're also acutely aware of the role employers play in this issue. Employer-provided retirement plans have done as much as any other force for good in helping people save and prepare for a secure retirement. Actually, the system is working well here in Iowa. Iowa ranks number 3 in terms of employees having access to retirement plans through their employer. This state is at 68% of the population has that kind of access. And we need to encourage more of this. And so we need to make it simple for employers. Now, of course, the issue with this bold plan by Chairman Neal is the concern about requiring employers to provide a savings vehicle like this. So to those representing small business outside this room or inside this room, we know you are the lifeblood of the American economy. We also know that you can't survive if government imposes excessive or unnecessary regulations. But I can assure you that this auto-enroll retirement savings proposal is not that. It is not a big government-run program. It is not something that requires tax increases. A proposal like this is as simple as setting up a direct deposit to a bank checking account for the employer. Think of it as no different than offering a payroll deduction for a membership in a gym. It can be done at virtually no cost or burden to the small business owner. And at the same time, you were offered a benefit that can be life-changing to a family. It uses the private sector, again, at no cost to taxpayers and without creating a patchwork of new government requirements for employers. So we are convening people on this, and another important piece of retirement security policy that will allow small employers to join together to make plans more affordable, so they can spread the financial and legal obligations among multiple employers. Next week, we'll be joining Chairman Neal and his little kitchen cabinet. He and Ranking Member Congressman Brady have jointly proposed this in the House, where we hope to move the legislation through that will create this important change in allowing small business employers to band together to offer plans. Chairman Grassley and his ranking member, Congressman Wyden, have already introduced it in the Senate. And it's a good package, a good first step, or the 1-2 punch of the ideas we're talking about. It's the first punch. And it's one I think we can actually get done this year, which for anybody who follows politics in an election year, particularly as we're moving into a presidential election year, that's not easy. I was actually at WHO TV yesterday doing an interview as part of the public affairs program that the political correspondent there has, and he said, okay, what are the odds anything? This is great you're talking about retirement security, Susan, but what are the odds? Seriously, what are the odds that this can get done in Congress at this time? And I said, I'm very bullish on this plan being passed, and here's why. It's the secret sauce. Number one, there's clearly a need to address the retirement savings gap in this country and have policies that incentivize more savings and nudge more savings. But secondly, there's bipartisan support for this. So that's the secret sauce. When there's a will and there's bipartisan support, you can get something done. So I remain optimistic that we'll get one thing done that's very important to Americans in this world where we're trying to provide leadership. Because retirement security is a natural leadership area for us. And I would say it's one that isn't new. I don't know, I just learned this. I don't know if people in this room already knew it, but the life insurance industry was there in the 1930s when the nation was at a financial crossroads. And it was life insurance company actuaries who offered their expertise to help develop the Social Security system. As you can imagine, it was a controversial undertaking at the time, but the heartbeat of our industry was and continues to be to provide solutions to Americans who are facing real financial challenges. So we're going to use this strength of industry, our political influence, and our persuasive capabilities to continue to be a problem solver, a global problem solver on this issue, and advance policy that really makes a difference. People want to care for their families. Paid family medical leave is an issue that's catching fire in America today because it's about a basic human need. In fact, I think it's one of the fundamental needs we all have, the need to care and be cared for. Paid family leave has the attention of leaders on both sides of the aisle and across all sectors. In the past 4 years, the number of lawmakers supportive of paid family leave has more than doubled. On the Republican side, for those who listened to the State of the Union, President Trump talked about this and put down a marker that we need to work to a bipartisan solution. Iowa's own Senator Joni Ernst, along with Senator Mike Lee, introduced a bill. Senator Deb Fischer, a neighboring state of Nebraska, has introduced a bill. So that's on the Republican side of the aisle. They're working hard to try to advance a solution. Same is true on the Democratic side. Senator Gillibrand of New York has sponsored a bill, and I know, being in Iowa, you've heard several candidates for president are proposing paid family leave programs. With paid family leave as an issue, we don't have a solution yet that everybody has agreed on both sides of the aisle, but we do have is bipartisan support to figure out that solution. So as somebody who's been working in the politics and policy area for 30 years, I can tell you that's a critical start. When there's a political will, we will find the way. So with paid family medical leave, we're at the stage where there is a will and smart people are actively trying to figure out the solution. Private sector businesses have started to lead on this already, of course. CEOs of insurance companies, many represented in this room, are enhancing their own paid family leave policies. They, like other big employers that are competing for highly skilled workers in an increasingly tight workforce, know that this is a benefit that is vital to their employees. This is an issue that's a natural for our industry to be concerned about because, for starters, caregiving directly affects a person's ability to save for retirement. It's particularly burdensome on women, who are more likely to be the one taking time off of work to provide care, whether to a child or an aging parent, and more likely to live alone and need more money in retirement. 1 in 5 women take time out of the workforce to care for a baby or relative. On average, women lose over $300,000 in wages, Social Security benefits, and retirement plans over a lifetime because they took time off of work to provide care to a family member. We don't have to wonder too long about why women are saving half as much as men for their retirement. We, the life insurance industry, need to be there in this conversation, leaning in and providing knowledge. Again, it goes back to Dave Levinson looked at the other side of the equation. Majority of women are now primary breadwinners or co-breadwinners. They're making the financial decisions in the family or heavily influencing them. So they are just important, understanding from a place of empathy the challenges they have in terms of caregiving needs and retirement security needs is a perfect interconnection with sort of where the business and marketplace opportunity and need is. So over the last couple of months, I've made several visits to Capitol Hill with some of our member company CEOs. Many policymakers are astonished to learn that we have a private market solution to maternity leave and to parental leave. Did you in this room know that 47% of private sector workers are covered by short-term disability policies, and maternity is the #1 benefit paid? So if you are an employer today offering paid maternity leave, you're likely using our products to do so. That's a story we need to be telling, and it's certainly a conversation we need to be part of. Now, there are things we need to work out, of course. Almost half of private sector workers is a lot, but it's not all. And just as we are on retirement security, we need to work with policymakers to figure out how to incentivize expansion of the private marketplace. And in this day and age, it's not enough to have just maternity benefits. You know, dads need time too. Parenthood also begins in many different ways. I know this firsthand. I'm the mother of 2 children. I have a biological daughter and an adopted son. And we need parental leave benefits that support American families in terms of whatever their needs are. Of course, some of our companies are already beginning to offer that kind of benefit, parental leave for birth or for foster care or for adoption of a child. Some of our companies are beginning to offer that for their employer clients. So by bringing the full intellectual resources of our industry to bear, we can support policymakers and our customers and consumers. We need a seat at that policy table so we can teach others that a private market product exists, and we can also be a thought leader on policy ideas that can galvanize more private sector coverage, just like we're doing with retirement security. Finally, people want to feel that financial peace of mind is accessible and achievable. Taking into consideration the more diverse, more complicated socioeconomic and political culture of modern America, financial literacy and inclusion are just so important. They're vital. For centuries, this industry has served all Americans. Today, we are just as committed to empowering all Americans, regardless of where and how they work, economic status, race, gender, or stage of life. We want all Americans to have the information and tools they need to make sound financial decisions in today's marketplace and plan for their future. But for families to have peace of mind, we must make sure information is available and accessible to them. We can do this through a commitment to financial literacy and inclusion. Let me start with financial literacy. Financial literacy is making sure families are equipped with knowledge. You don't need to earn a high income to be financially secure, but you do need to have a plan. You need to be purposeful about how you are protecting your family by taking steps like owning life insurance or disability insurance and having emergency savings. You need to have access to products like annuities, the only product that guarantees an income for life. How consumers understand the products available to them and how they fit in their own financial plan is of deep relevance for our overall financial preparedness as a country. For instance, we know people overestimate, it's been talked about here by multiple speakers, the cost of life insurance by 3 times the actual cost. We know consumers need to see a glimpse into their future retirement savings to understand exactly how much they will need. And half of workers who saw an estimate of retirement income increased their savings. Financial literacy would correct the misperceptions around what it takes to achieve financial security. Think about this. 25% of the most financially secure households earn $50,000 or less annually, meaning that income alone does not determine financial security, but financial literacy and preparedness does. The financial inclusion part of this is making sure we advance people, regardless, again, of where and how they work, economic status, race, gender, or stage of life. Inclusion is making sure all communities have access to the information and products they need to protect their financial futures. The first hurdle in accessibility is self-efficacy. Does a person even feel financial security is achievable? Many in underserved communities would say no. We need to change that. Financial inclusion is deeply rooted in empowerment. Access to financial products and services is a key link to economic opportunity and financial security. Inclusion means that our financial products and services are readily available to all individuals and that they are actively using the services to meet their needs. Financial literacy and inclusion can be a powerful conduits for growth, and our industry is well equipped to take up this mantle. We have trusted financial professionals on the front lines with clients. Our partner trades like NAFA are doing great work in making it a priority to recruit a diverse set of financial professionals to represent the communities they serve. To put it frankly, our young people and all people need to see other people who look like them making smart financial decisions. And Dave Levinson said this as well. They need to see other people who look like them advising them. ACLI is working one-on-one with government officials who want to actively deliver financial education to all communities. We're also partnering with organizations like Junior Achievement to raise the conversation around financial inclusion and financial literacy. Well, our industry has served this country for centuries, and we can continue to serve this country as it grapples with the financial and retirement savings gap, paid family leave and caregiving, and financial wellness and inclusion. Of course, to deliver the full potential of our contribution, we need a stable, predictable federal tax structure that allows us to do what we do best, build a private sector safety net for all Americans. We need privacy regulations that protect the consumer without restricting our ability to offer products priced fairly for all consumers. And we need a harmonized national standard of care so we can continue to operate in the best interest of our consumers. Those are all things we are fighting for and will continue to fight for because they directly impact our ability, this industry's ability, to adequately and fully address the needs Americans have today. So let me conclude. There are human factors at play in every public policy debate and in every societal discussion. These are truly kitchen table issues. They hit at the core of people's lives. We know we are not the hero of this story. This industry empowers people to be the heroes of their own stories. The mission of our industry is not just encouraging financial savings, it's more than that. It's about offering people a chance for a strong, vibrant, dignified life. There's great human need, and we have great solutions. But we need to lean forward and to be purposeful to realize this full leadership opportunity for our industry. The question we need to answer is, what do our consumers and society need from us? We are most effective when we understand the motivations and core beliefs driving those needs and connect them with the strengths of this industry. When we do, we will be a powerful force for good in this country and around the globe. And if supported by robust policies, I am confident we will see a bright financial future for all Americans and thus this industry as well. Thank you very much. It's been such a pleasure and privilege to be with you. Thank you.
We're going to take another short break so you can refill that coffee, get a can of soda, can of pop. We're going to rearrange the stage here for our commissioners panel, so another 5 to 10 minute break and we'll get going again. Thanks.
Very good.
Oh, our mic's
Oh, we're live.
Oh, and they move.
You can tell when the commissioners get on the stage, the whole room goes quiet. So,
It's kind of sad.
up next is our commissioners panel. So, I have the good fortune to introduce the moderator of that panel, a real industry veteran, Pat Hughes with the Faegre Baker Daniels firm. So, Pat is a strategic advisor, public policy advocate, and regulatory attorney for insurance industry clients across all product lines and services. He's a former senior insurance regulator in Illinois, where he also led critical NEIC workstream. Pat works with a team that uniquely crosses state, federal, and international lines to deliver solutions on emerging and high-impact issues. So we thank the commissioners for their participation in our panel, and I'll turn it over to you, Pat. Thank you.
Thank you, Eric, for the kind introduction. You know, the last few days, we've been talking intensively as a group about the intersection of innovation, the insurance industry, and regulation. And for Commissioner Oman and the rest of the organizers here, I think we owe them all a great debt of gratitude for how engaging that conversation has been and continues to be. Now we're joined by the commissioners, the actual insurance regulators, and the NEIC, who are really at the front line of some of those issues. And so we're very, very fortunate to get their perspective on some of the most important issues that face the state regulatory community today. And we've assembled a group of leaders with unique insight and background. I will intentionally not do them justice in the introduction because I know that you want to listen to what they have to say about those emerging issues. But suffices to say, we're dealing with the cream of the crop regulatory leadership, as well as joined by many of their colleagues in that same group. So in order, I'm joined by Pennsylvania Commissioner Jessica Altman, NEIC CEO and former Pennsylvania Commissioner.
Right.
There's a bit of a cabal there. Mike Considine, Oregon Commissioner
Future
Andrew Solfi.
Future Pennsylvania. Yeah,
And future Pennsylvania, right,
Commissioners-
exactly.
Oregon commissioners tend to become Pennsylvania.
Yeah.
Gotcha,
So-
okay.
It's a
we're
weird
working on it.
pipeline.
That's-
It's a weird
We've
pipeline.
got it all. So, I don't know, Ken, what you and I are going to talk about all day. But, and of course, all
left.
the way down our Texas Commissioner, Ken Sullivan. So thanks for joining me and really looking forward to the discussion. I should add, we're going to try to save some time. We're not just going to try, we're going to succeed for robust audience questions, which need to come in. The instructions will be given through text, and we'll gather those up and hope to include those in our conversation. So very much looking forward to that aspect. So appropriately enough, let's start with modernization and regulatory innovation. The State Ahead program has been out there for a couple years, major initiative of the NEIC, emphasizes leveraging technology, leveraging innovation for more effective regulation. President Chapa has recently reaffirmed that commitment. So my question, and I would like to start with you, Commissioner Sullivan, is what does regulatory innovation mean to you? And is there a particular initiative in your state that you would like to highlight that shows where those types of initiatives might be going?
Well, for me, I've been in office for about 18 months, and after having a chance to sort of survey the status of where we were, it occurred to me that we needed to focus on some pretty basic blocking and tackling. We have tried to focus on three sort of overarching initiatives. One is adoption of best practices. Second is modernization of our infrastructure, which is mostly meant trying to make sure that we have cutting edge technology and the use of effective communication. We have a plain language initiative that we're proud of in terms of trying to insist that plain, consumer-friendly language and communication is used both by TDI, but also by the industry in terms of dealing with our consumers. So that, broadly stated, is probably the most significant areas we've been involved in. But a couple of specific examples would be one in terms of practices that we're looking at is we've announced an initiative to the industry asking for them, we're setting up a timetable for later this year to identify our historical rules that they believe need to be revisited, either because they're no longer modern and up to date, or they're perhaps overly burdensome and not, if you will, user-friendly. No guarantee, of course, that we will take them up, but we're asking that they be identified so that we have an opportunity to have a discussion in a formalized sort of way, and then potentially select rules to be revisited. So we hope that that will yield positive results. But we've done a lot of other things. We've tried to change from a lot of static models to dynamic models in terms of capacity management. We operate several call centers. We process a lot of applications. And what I found is probably what a lot of you experience, and that is the models that were in place were very static. And when you had peaks and valleys of demand for services, we simply had a bureaucracy that didn't react and couldn't react. And so we've changed a lot of that, and I could give you some yardsticks, but I won't bore you with that. The other thing I'll point out just very briefly is we've got an artificial intelligence initiative that's going on in terms of trying to facilitate better form review, in terms of making it faster, but also in terms of trying to enhance regulatory consistency. I think of it in terms of vertical and horizontal consistency, measuring decisions that are getting made against historical decisions that have been made within the state of Texas historically for similar provisions, similar form issues, if you will, and then horizontally to be able to be aware of what other states have done with respect to similar regulatory policy issues. And by being able to access on a very rapid basis that sort of information, I think we can leverage our people a great deal, and we can produce better quality decision making. So those are just a couple of examples.
Right. Now, Commissioner Stolfi and Oregon, you've got a specific mechanism that you're trying to get up and running. Any of that ring a bell, or anything you want to highlight?
Yeah, thank you, Pat, and want to give a quick thank you to Commissioner Ullman for the invitation. Very happy to be here with everyone today. And so what we did is first say, or what is innovation? What might we see? And there's innovative products, there's innovative services, there could be innovative delivery systems. All of those could be by legacy companies or new companies. And what we need to do and what we're doing is being prepared and getting our office ready to receive these products and review these services and approve these delivery systems by any of the companies that come to us. And Commissioner Sullivan mentioned statutes. Our statutes are maybe not suited for new and innovative products and services. They're could be decades old, requiring wet signatures, printed policies to be sent around, things to be sent through the mail. We have desk drawer rules, which could be different between our different product regulation reviewers. There's also a component of kind of change management within our office, which has been interesting to work through. We've got a team led by a millennial, which is great, and we've got product reviewers who have sometimes been there for 20, 30 years who have to kind of learn a new approach to looking at things. And so in order to kind of accomplish what our goal is, which is to help companies get products and services to consumers as quick as possible, we've created an innovation hub and appointed an innovation liaison. And that's just a fancy way to say we have a page on our website telling the world that we're open for business, and we've appointed someone who's a point person for companies, for individuals to go to and say, I have this new product, I have this new service or system, and I'm not quite sure how this fits within your regulatory framework. Can you help me, instead of just going and filing it in SURF and then waiting for someone to get back to me and go through the system like that. So we're open for business and ready for folks to come to us.
What's the latest and greatest along those lines in your neck of the woods, Commissioner?
Yeah, so in many ways, I think from the regulatory perspective, I view innovation, modernization as a cultural shift and an attitude, as much as it is looking for ways to actually improve our own use of technology. Commissioner Sullivan gave some great examples of that. I'm privileged in Pennsylvania to work for a governor, and one of his core themes and missions is a government that works. And he has really no patience for the silos and the bureaucracies and the traditional things that have kept government from working at its most efficient, working at its best, and really providing that customer service, whether the customer is a policyholder or an insurance company. And I mean that in a really good way, having no patience. And what that means for all of us who work in the Commonwealth is we have to embrace change, and we have to be open to change and have that open door policy and the door is open kind of policy. And I think that's really what you're seeing now with regulators across the country. We want to encourage innovation. We want to allow for and facilitate innovation in the industry that we regulate. And at the same time, we want to keep an eye out for ways that innovation has the potential to err against some of the principles that we have always held in the highest of regard in the industry, like non-discrimination in rating practices when looking at big data and predictive analytics, et cetera. And so I think for me, as we look to take many of the same steps already mentioned, it's really about making sure that myself and my team are having that openness to change and openness to taking a new perspective.
So Mike, we've heard what's happening at the departments. What's happening at the NEIC on these types of initiatives?
Yeah, happy to answer that question, Pat. And first of all, thank you also to our hosts here. It's great to be back in Iowa. My ties to the state go back to my former life at Transamerica, where I met my now wife. So I've been issued my Iowa State jersey, which I know makes me feel unpopular about the other half of the state. And she's tried to disabuse me of any notion as to the superiority of Pennsylvania corn versus Iowa sweet corn. We've actually had arguments on this. But so I've been fully
You're managing a lot, Mike.
Yeah, I've been fully immersed into the Iowa culture, in addition to also managing the transformation of the NEIC through our State Ahead initiative. And for those of you who don't know, this is really the plan to innovate our regulatory system. As you've heard from my members, our regulators, there is a lot that we need to do at a regulatory level to keep up with the incredible pace of change that we've seen over the last decade, which seems to be only further accelerating. And you look at insurance as a product, and you look at it over the course of its lifespan here in the U.S., a couple hundred years. The product design, the product sales mechanisms, even and the corresponding regulation didn't really change that much, really up until sort of this last decade when you started to layer on data and technology. And having come from a large company, I know the investments that many of you are making in platforms, I know designed to better serve your customers by harnessing the value and wealth of data that's out there to tailor products and services. But that's opening up all kinds of questions and challenges to regulation that we need to keep up with. So we embarked on a pretty radical plan to really position the NEIC, which is a member support organization, to support our members in this new landscape. And we're going to have to do it in ways we haven't necessarily done in the past, focusing on our talent. We've relied heavily on financial analysis and actuaries, but now we're going to need data scientists, and we're going to need modelers, and we're going to need other talents that we haven't had to use in the past. We're going to really have to invest in our own data so that regulators can really understand at the same pace that you all are what's happening in their markets at a company level, at a consumer level, and then of course the corresponding technology. So we're about halfway through what is designed to be an initial three-year plan, but I fully expect that there will be a State Ahead 2.0. And the other part of that, which we'll probably get into, Pat, is recognizing that from a policy standpoint, important. You've heard about this from some of our prior speakers. We are in a period where states are put in a position of leadership to regulate their markets in ways that they haven't been able to before. So we at the NEIC really want to make sure that our members are in a position to succeed, to serve their markets, to serve their consumers, and really to give them the talents, the tools, and technology they need to do so.
Well, thanks for that briefing. That's obviously something people are keeping an awful close eye on. Commissioner Sullivan, could you briefly touch on how the NEIC is approaching, I don't know if you want to call it the other side of the picture, but the industry side, use of big data, predictive analytics. I know we could spend 2 days on that alone, but just where is that housed? What should we be looking for in terms of activity in 2019?
Well, I'm certainly not an expert, and there are probably better people to answer that question, but my general view is, you look at this issue in sort of different buckets. Data security obviously gets a primary attention, which I think of as just sort of unauthorized access issues, data breach issues, but data privacy and data use, those are areas that are fairly close behind. And there's a lot of ongoing discussion about that. But in terms of data security, I mean, the federal government has obviously set expectations that in less than 5 years that they have an expectation that we will take action and set sort of minimum standards for data security. The NEIC does have a model data security law that I think was adopted in 2017. And New York State has promulgated regulations that are arguably even more restrictive than that, and they've taken a fairly expansive attitude in terms of what the reach of those regulations should be so as to potentially influence data security practices across the nation. So I think it's it's a fluid area. Right. There's going to be a lot of discussion over the next several years about exactly where this should land. And there's going to be discussion between states, and there'll be discussion between the federal government and the various state governments as to exactly where this should end up.
Where it's going. Let's shift our focus a little bit to the equally small area of healthcare and how it's regulated. We could spend a lot of time on that. In D.C., at least, political debates keep moving around. ACA passed without a Republican vote. Republicans run on repeal and replace, but then that didn't happen. Now many Democratic presidential candidates are full throttle to Medicare for all or similarly described single-payer type of approach. Meantime, we see commissioners and consumers at the state level continuing to try to make things work in their states. I would agree with you on your governor's reputation. He's dealt with divided government and getting things done. For that reason, and because also you're the chair of the Healthcare Focus B Committee, maybe it makes sense, Commissioner Altman, to turn to you and see what advice you think state commissioners can have to find compromise and to actually get things done in the healthcare space.
Yeah, I'm going to start with sort of 4 things that I think insurance commissioners, no matter what state we come from, no matter what political affiliation we do or do not have in common. The first is we really do share the value and the goal around our healthcare system. We want people to have the ability to protect themselves and access the care that they need. We want them to have coverage options and have choices, and we want those to be affordable. And so it's very easy to get mired in the differences we have about the pathway we want to take to get to those goals, but starting from recognizing that those are goals that we share regardless of our differences is really important. Second, we know insurance. And so that might seem very obvious, but in healthcare, we sometimes get so mired in the politics that core principles are lost in the shuffle. And insurance commissioners, once again, regardless of where we are, if we're talking about risk pools and adverse selection and subsidization and risk adjustment and reinsurance and all of these very technical things, we get it and we know how they work in practice and we know what we can do to make things better. The third is we all support the state-based regulatory system. We have all seen the power of states both being innovative and working on their own, but also the power of states being collaborative and working together. Which gets to the final point, which is the NAIC is really a place where we check our politics at the door. And we have a long history in the insurance regulatory space of reaching across whatever aisle there is that day and saying, how can we work together to solve this problem in a way that works for your market and my market and the market over there, even though those markets may be very different. And so because of all of those things, it's really a privilege to chair the B committee right now. I often get people joking, condolences on that one because health insurance is so hard, but I actually view it as an opportunity to be in one place where we might actually be able to cut through the noise and talk about what can we do to make this better. And so that's what we're trying to do now. We're having a lot of conversations about where can the NAIC help move the needle in a positive direction for all of the members of the NAIC. So it's really an exciting time.
Your folks are in a position where you can't make speeches or posture. You've got people and programs that you have to implement and are responsible for, and it comes through in your approach, and I appreciate the way that you outlined it. It's hard to talk about healthcare without talking about costs. It's hard to talk about costs without talking about cost of pharmaceuticals. Leads to other issues like transparency, how that market is made to work correctly, and what's the proper government role, small issues like that. Commissioner Stolfi, from your perspective on that, or picking up on what Commissioner Altman mentioned about the healthcare priorities coming out of the NAIC?
Thanks, Pat. And healthcare and prescription drugs are a clear priority for every commissioner, every state. There's an obvious, clear recognition that the rising cost of prescription drugs are a hardship for Americans. The insulin, high cholesterol drugs, new drugs entering the market. We're seeing increases that really are, in some instances, unexplainable, or at least not sufficiently explained. And the good news is that there's a clear bipartisan recognition that something has to be done about this. And we're seeing that across lots of states. And there's a lot of people who have a lot of really good ideas about what could be done. And there's also a lot of finger pointing between the different players in the chain. I had the opportunity last year to participate in a prescription drug task force in Oregon. We had participants across the entire supply chain. And everyone thought that every other person was responsible for the prices we're seeing. And I think there was not a real accountability on any individual's part. But what in my opinion, the best policy decisions are formed when you have the most actual information. So what we've tried to do in Oregon, and what I've seen across the board, is trying to figure out what are the reasons for these price increases. And because the system is so closed, and insurance regulators, we don't have a real kind of direct connection to a lot of the players within the supply chain. What we can do is help to shine some light on the process and increase the transparency. And we're trying to do that in Oregon. We've got this second in the nation, and I think the most robust prescription drug price transparency program. We've had to stand this up within the last 6 or 8 months. And it has a couple goals. One is for drug manufacturers, where we see price increases of 10% or more. The manufacturers have to file something with us explaining the reasons behind that drug increase, talking about their R&D costs, their net profits, their marketing expenses, the cost of those drugs in other countries, to really demonstrate here's what's driving costs. Insurers have to share with us each year what are the 25 most expensive drugs, which are the 25 drugs increasing costs, plan costs the most. And then very importantly, we're allowing consumers an opportunity to talk to us and give us notice about drug price increases. And what we're going to do with all of that, including the information sent to us by the insurers, is make that public. So everyone here in the room and around the country is going to be able to see the explanations, the reasons why why drug manufacturers are increasing their prices. You're going to see what drugs in Oregon are really driving costs. We're going to get to see the complaints that consumers have around rising drug costs. We're going to have public hearings and information. And one thing I'll just add that's been really interesting about this whole process, drug manufacturers like PBMs are not used to being regulated. And it's been a struggle at times placing even the light framework that we're placing around simply reporting of information. So I think it's going to be a real challenge as we move forward, figuring out once we have that information how we can best use it to then drive down costs.
So Commissioner Sullivan, there's a state aspect here, there's a federal aspect here. From your perspective, how do the state and federal roles on these thorny issues, intersect or interplay?
With great difficulty. I think the significant problem that we've got is just uncertainty in this entire area. I mean, if you look at issues like drug pricing, you look at just healthcare insurance in general, regulators and consumers have really suffered under a tremendous amount of uncertainty in recent years, wide swings in expectation in terms of policy, particularly at the federal level. You've had the impact of litigation and the impact that has had on expectations. You've also got the bifurcated marketplace. In Texas, I've got about 16% of the market. The marketplace is dominated by ERISA plans, i.e. Employer self-insured plans, and that is growing. And I think that our market, the state-regulated market, is continuing to shrink. The ability to impact things for us, I mean, various states have looked at 1332 waivers and the like, and that's been a very changing landscape. When we looked at it when I first took office, the expectation was set that it would take 18 months at an absolute minimum to successfully navigate the process. Well, 18 months in this area is like a lifetime. The policy direction could change 2 or 3 times, or litigation could impact expectation. So, candidly, I suspect it's going to take at least one more round of elections to begin to settle things down at the federal level so that we can more intelligently plan.
All right. Well, we've solved healthcare bipartisanship and drug pricing, I think. So we've got some momentum here as a panel. So let's solve long-term care. Let's do it. Commissioners are concerned, governors are concerned, people are concerned. When I visit Mother Adelaide, I hope that she lives a long time, and I hope that my career goes really, really well, because if those things are in tandem, there's a lot of risks associated with, as we live longer, and expenses that are associated with that. Mike, I know there's a lot going on at the NEIC at LTC. There's a new work stream that's been opened up. Can you get us up to date on how the NEIC as a whole is looking at those very, very significant policy issues?
Yeah, well, this is definitely one of those areas and issues, Pat, that certainly keeps me up at night, and I know many of our members, and that's because it, has an impact on both sides of the hats, each member wears on the solvency side and the consumer protection side. And it has been a priority issue for us for the last couple years. And really what we did this year is take existing sort of work streams and elevate them. So we formed a new executive level task force to really focus on the issue of rate consistency in the long-term care area. It's a very specific issue, but it's an important one because, again, it has an impact on both the solvency and consumer protection side. Fundamental to a working state-based insurance system is a certain level of consistency or uniformity between the states and how they deal with rates and how they deal with forms. Just given the disruptive nature of LTC, we've lost a little bit of that cohesion, and I think really this group is refocusing on how we get it back, how do we make sure that states are coordinating, communicating, sharing information. I think it's important to emphasize this is not about granting rate increases or higher rate increases. This is as much about making sure that there is communication and coordination, as I said, so that states are acting in ways that recognize that this is a national issue. It's one that we at a state level kind of own because it really is a product that we have been regulating or trying to regulate. And so we hope to make really significant progress in this specific area over the course of the next year, and everybody sitting up on the stage with me has been a big part of the leadership in bringing this together. We will still have a combined B&E task force that will look at a broader array of issues, including the future of long-term care. It is a product, or something like long-term care is desperately needed going forward, just again given the retirement and savings issues we have here. Medicaid costs for states continue to go through the roof, driven primarily by nursing home costs. So this is another one, as you've been hearing about. We can be part of the solution, and we recognize that, and we're fully on task.
So Commissioner Altman, how does, I think we hear a lot about new product design as an aspect to this, as a response to this. What are you seeing in that regard, and in particular as a regulatory role? What's going on in that space? It seems like such a natural industry response, and there might have to be there might be regulatory issues along with that as well.
Yeah, no question there are more products on the market, different hybrid products, for example, that are garnering a lot of interest. So there are two things we know about traditional long-term care insurance. One is its availability has significantly decreased over time. There are only maybe 10 companies now actively selling traditional LTC in the marketplace. And the second is that when traditional LTC is adequately priced, which we could spend a whole other time talking about whether it is, but if it is, it's very expensive. And so with that framework, there isn't any loss of interest and need for preparing for the risk of long-term care. And we have a societal problem with lack of savings for retirement in general, which includes long-term care. And so you have consumers who want to, rightfully so, protect themselves from these risks, and an industry that wants to help them do that while also having more certainty from their side, from the financial perspective, given the volatility of traditional LTC. And so I think the question with product innovation is, can we do both? Can we have products that provide more certainty to the industry while also providing that financial security for these types of needs to the policyholder? One thing I've been thinking a lot about recently is, as the insurance world has really been focused on traditional LTC and legacy blocks, state Medicaid programs are generally the largest payer of long-term care services in any given state and in the country, because they become the payer when individuals who need long-term services and supports exhaust their assets otherwise. And many of those programs have really been revolutionizing the way that they pay for these services. And just like in health insurance, we are constantly talking about costs and what we can do to find more value and maintain quality while bringing down what we're paying. I think we need to have more of those conversations on the long-term care side. Pennsylvania has just launched a whole new managed care program through our Medicaid agency, really focused on keeping people at home who need these services, both because they want to be at home, but also because it is much cheaper to keep them at home. And if we can do something that makes people happier and costs less money, I think we should be thinking about how we might be able to do more of that. So a lot to be found there, a lot to be discussed.
Well, we started talking about the future apropos of this symposium. Commissioner Sullivan, we also have to spend a lot of time thinking about the past with the legacy block issues. How do you define those issues and how commissioners have to respond to the LTC legacy blocks?
I think that they primarily need to grapple with respect to the legacy blocks with the solvency issues. And I think we've got to view this as largely a solvency issue. At the end of the day, from a financial standpoint, policies have to be self-sustaining. And the notion of trying to frame the issue of rates entirely by consumer protection type of rhetoric, particularly when used to justify the denial of rates that are otherwise actuarially necessary, I think has been problematic, and there has been some of that. My view of consumer protection is that consumers deserve to make their own choices, and they need to be informed choices, and that we as commissioners should not choose for them. And making decisions that will inevitably lead to insolvency and companies being in guarantee funds, those are one-size-fits-all choices. And they, to me, are the opposite of true consumer protection, because I think the consumers need to be able to choose for themselves. I will say that in Texas, what we are trying to do is, number one, to try and ensure consumer education. We we insist really that companies, if they are looking for rate increases, that they explain in plain language, and we do get involved in terms of explaining what the rate increase is and what is really occurring, so that the consumer can understand it, and we ask that choices be made available to consumers. Either a phase-in of a rate increase, if it's a larger increase, to allow the consumer the choice to avoid the rate increase entirely if the consumer is willing to scale back benefits so the policy is otherwise self-sustaining, or cash-out options of one type or another when that is practical, so that the consumer can make that choice as well. That's our view of what the best alternatives are as far as consumer protection is concerned.
View from Oregon, Commissioner?
Yeah, briefly just say, to me overall, it's about balancing accountability and consumer protection. So how accountable should carriers be, how much accountability should there be for mistakes that were made, clear mistakes that were made in pricing of these products, and versus how much should consumers be protected from significant price increases. And solvency, of course, comes into play, and excuse me, wouldn't want to approach this in any way that threatens the solvency of a company, because that not only harms the company but the consumers as well. But these are significant questions that need to be addressed, and the Oregon way to do this is in an open and transparent process. I don't think it's fair to consumers or carriers, for that matter, if we simply are making rate decisions and behind closed doors and then announcing them. So we're looking to create a much more open and transparent process to review these questions, and really look forward to working with the new task force on that process.
Great. Well, there's a lot more to explore, but we want to make sure that with our limited time, we also open it up to audience questions. So Eric and company, do we have anything?
We do. We have had a few questions submitted. The first one that's being asked is, how do you balance the data transformation that's going on with data privacy? So insurance companies, carriers using data to transform how they maybe underwrite, how they gather information versus data privacy.
The balance with privacy. Any jump ball takers on that one? Mike, from the NEIC
Sure.
seat?
Yeah, I mean, again, this is a huge issue, and we recognize, both sides of it. I think the focus for us has been, and again, Commissioner Oman has been a real leader for us on the data side in understanding exactly first what companies are using, and again, it's just sort of a transformation in terms of the extent that data is being used to make decisions regarding underwriting and rating that in some way challenge traditional insurance notions or mechanisms around both of those processes. So we're trying to understand first and foremost what's happening. But then it does bring into the question, how does regulation adapt to that? Because our regulation, particularly when it comes to discrimination, is based on criteria that are a little bit harder to deal with when you're dealing with computer algorithms and AIs. The process behind which sometimes even companies, I think, are challenged to explain. So part of it, I think, is, and it's going to be a policy discussion that is already starting to take place at both the congressional level and certainly at a state level and a global level in terms of what's the accountability for both companies and what's the appropriate regulation. We've heard from some on the industry side, well, it's math, it's algorithms, you can trust math. Well, you can't. Actually, and we expect, and I think our regulators expect a certain level of accountability and transparency by the companies involved to the extent they're using this new technology, and their moral compass and ethical compass really has to be set to true north when it comes to this. If they're truly focused on the interests of their customers, and there is the potential for harm in some of these technologies. Let's get our arms around that before we fully unleash it. So those are all discussions that we're having certainly at an NAIC level, but we're having it at an international one as well. And you've seen already policy developments in Europe and other places that I think we'll be watching very closely here.
Good. Want to jump in?
I would just add, for anyone who reads the newspaper, right, we know this is not an insurance issue only. It is an insurance issue, but it's a societal issue. And you see everything that has happened with Facebook. You see what Europe has done to create a new framework around data privacy. And so, the NEIC is very keyed into the conversations that are happening in D.C. and Congress around data privacy and really trying to be cognizant of the broader societal questions about how we as a country want to deal with data privacy issues. What are the rights of an individual consumer and their data, and what should they be? And then we need to be cognizant of how that translates down and really appreciates the state-based regulatory system that we have around insurance. And so it's going to be, I think, a big discussion this year, and the NEIC is going to be a really big part of that. So looking forward to that.
Good. You want to tee up another?
Yes. Another question around how do you keep up with the innovation that's going on?
There we go. Mr. Stolfi, Sullivan, want to?
Well, so I've appointed someone in the office solely responsible for tracking innovation that's going on at the state level, at the federal level, and internationally. She spends a lot of time traveling around the country, going to different conferences and seminars, just to try to keep up with something that we're just not, the traditional insurance regulator's office is not prepared traditionally to follow that.
And want to hear, Commissioner Sullivan, hear your perspective on that, but in answering that, for people that are here who are involved on one level or another in innovative enterprises, whether that's at a current insurance company, a startup, a vendor, how best can they interact with because I think that's probably music to a lot of people's ears here, that those sorts of things are happening in Oregon and elsewhere. How can they take that to heart? How can people that are assembled here take that to heart and best interact with you, knowing that you are trying to do just that, to keep up with those innovations?
Well, I'd say reach out to us. And in kind of thinking through this last year and how we wanted to approach it, it was almost a chicken and the egg issue where, we didn't really have companies and people coming to us, and we were wondering if that's because we weren't telling people and companies we are ready to hear from you, and we want you to come here. So to everyone here, and we're ready. I think every insurance commissioner in their office is ready to hear from you, to work with you, and to help you. So please reach out to us.
I'd just say the NAIC Innovation and Technology Task Force not only is wonderful on its own, but one of the things they've done is created a centralized list of innovation contacts at each of the insurance departments. So an actual name and email address of the right person to contact if you want to be engaging with a specific department on issues around innovation. So don't be shy to use that. That's why we created that resource.
Mr. Sullivan, from your department?
Well, I think at the end of the day, the most important thing is we regulators have to walk the talk. And with respect to Texas, I meet with people routinely, and I encourage people that to the extent that they're dealing with folks in our department, and we have a large department, and they don't feel like their ideas are being facilitated, I encourage them to come talk to me. And as I say, the proof is always in the pudding in terms of what steps you're willing to take to really try and facilitate innovation. I think that's where it's all going to rest with all of us.
Great. We might be able to sneak one more in. I would love to do that.
Yeah, there were several questions on long-term care, which I think you've adequately addressed, but there was a question on short-term care and if there's anything going on with respect to that.
You mean short-term, long-term care, or short-term limited duration insurance and health?
I think it's the latter.
The latter. Okay.
In 47 seconds. If you don't mind.
Sure. So short version
you can take your time.
of what? Yeah. No. I got it. 40 seconds. So the Trump administration issued a new regulation last summer that really opened the door to short-term limited duration insurance products, which are insurance products that were meant to do exactly what they're called, fill short-term gaps in coverage, and they don't have to, depending on state law, comply with any of the ACA protections. They can exclude on pre-existing conditions. They can have annual and lifetime limits. There's a really varied perspective among states about the role of those plans and what it should be. Many states have taken action to further restrict what those plans are. I didn't make it, sorry, 40 seconds. Some states are looking at this as an option to bring people back into the insurance market who previously left. And other states see a lot of consumer protection dangers, a lot of risk segmentation dangers that could really undermine our markets. I definitely fall in the latter category. I actually testified in Congress about some of the things we have seen in Pennsylvania and some really sad stories of Pennsylvania consumers who thought that they had real adequate health insurance and went to use it and found out that they had next to nothing. So I think this is one where it's going to be a state-by-state question, and we're going to see states taking actions in different directions across the board. One thing we all want is to make sure if these products are in our market, they're sold accurately and fairly, and consumers understand what they're buying.
One thing to just to touch on very, very briefly, I know that we wanted to just at least acknowledge is on the international standard setting front, which again, talk about we could do for 2 days. But just, Mike, from your perspective, I know the NAIC has you focused on those issues. The commissioners have you focused on those issues. And Andrew, you're on the G committee, the international committee. For people working at the desk level in 2019, what should folks be looking out for on the international standard setting front that is really going to impact at the business level? What are the work streams to really keep an eye on and make sure that you're up to date and understanding the impact of?
Yeah, an issue near and dear to my heart, and one that I am passionate about, and probably inherited that from Dr. Terry Vaughan, one of my predecessors, who I know this was a battle I have joined in. And it's around this issue of capital and international standards for capital, which immediately a lot of people's eyes start glazing over when you talk about the aggregation method versus MAV versus RBC. But for us, we're passionate about our position, not just because we think we're technically correct in our approach to group capital, which we are, but also because we understand the consequences of some of the decisions that are being made at these international tables about these issues, changes, which will have a ripple effect throughout our market. So we've been talking the last 2 days here about the role of the insurance sector in retirement and savings and dealing with aging populations and infrastructure investment. Well, if you want to do any of that, you need an engaged insurance sector, and the surest way to start to interfere with their ability to do that is to impose standards that limit their ability to invest or make long-term decisions. So this year, we will get to some key decision points around the international standards. And I think, Pat, what you're seeing is a real sort of unity between the different parts of our Team USA, which is, the Treasury, Federal Reserve, very strong statements coming out of Vice Chairman Quarles. We're going to have Secretary Mnuchin at our international forum in 2 weeks. I'm sure he'll speak to that. But we understand what's at stake. And, this is a hill we are going to fight for, because it is important not just for the technical reasons, but for the consumers and markets back here who will be impacted.
Right. Any gloss from the G Committee perspective? And you, of course, were a senior official at the IAIS. You've got a unique perspective on all this stuff, let's call it.
Yeah, and I think I'll say capital is very important, and it absolutely should take a lot of our time and attention, but there's so much more going on at the international level. And I mean, we're over our time. I could go on for an hour.
The red flashing light is a clue.
I'll just make a plug to say that, the NEIC serves a very important role about bringing the states together. So all of our states, we have different perspectives, and we come together through the NEIC because that's a way we can learn from each other, improve upon what we do at our states. A similar thing goes on at an international level, whether it's through the IIS or OECD or any other number of organizations, where we can go and learn from other countries about how they're doing things, teach them how we're doing things and doing things very well. And get to know each other so that when things go wrong, as they inevitably do, we have a better understanding about how we can work together to fix it.
Great.
Which I'll say is even more important the more globally connected we are. We're at a global insurance symposium for a reason. Insurance is and is becoming much more globally connected.
Right. Well, on a very personal level, I want to thank Commissioner Ullman and all the organizers for giving me the opportunity to moderate this group. It's truly a treat and a personal honor, and thank you to the 3 commissioners and to Mike for allowing me to participate in this conversation. And speaking of which, if you would please join me in thanking these folks for sharing their insights.
We are going to take our last break of the day as we prepare the stage. I'm going to ask you guys to stay up there, invite any other regulators and commissioners up to take a photo for a photo opportunity, and then we'll get the stage ready for Senator Grassley.
Well, everyone, we're nearing the end of our symposium, and I have the great privilege to introduce our final speaker, and that's U.S. Senator Chuck Grassley of Iowa. Senator Grassley has served as one of Iowa's U.S. senators since 1981. He has developed a reputation for independence and relentless oversight to make the government work for the people it serves. Senator Grassley was sworn in as Senate President pro temp for the 116th Congress, which places him third in the presidential line of succession. He uses his seniority to build bipartisan coalitions and has an agenda to improve opportunity and prosperity for more Americans. As the Senate Finance Chair, Senator Grassley expects to continue vigorous congressional oversight of the executive branch to make sure the federal government does its job. On a little more personal note to the industry, Senator Grassley has been a very big supporter of the industry. He's made himself available to us and our companies when we've needed help in Washington, D.C., and we appreciate that support. On a personal note, many of us who live in Des Moines and travel back and forth to D.C. on occasion do sit on planes with Senator Grassley, and I personally have been just amazed, Senator, at how many people speak to you on the planes and how willing you are to engage in conversation with them. So the Senator will listen to anyone who has a desire to speak to him, which is very refreshing. Senator Grassley, thank you for your engagement and your willingness to speak to us today. Please join me in welcoming Senator Grassley to the podium.
Thank you for that kind introduction. I'm glad to be with you. For those of you from around the country, welcome to Iowa. And you're lucky you come during the spring. Our winters are not too good. Don't tell the Chamber of Commerce I said that. I'm honored to be with you here in Des Moines. I'm not surprised that the Global Insurance Symposium is happening right here in Iowa. We have a good reputation on insurance. Iowans don't brag enough, but this event proves how Iowa is a hub for the insurance industry around the world. I just love to tell people out east, particularly those from Connecticut, that Hartford, Connecticut is the Des Moines of the East. I'm going to use this opportunity for what I've been directed by your leadership to do, to update you on the work of the Senate Finance Committee, where I serve as chairman. The committee has a full agenda, and those of you that think Washington doesn't work hard enough, you should welcome the fact that at least our committee has a full agenda. We're focused on a number of critical issues, including retirement policy, prescription drug pricing, implementation of the new tax law, international trade negotiations, and oversight of other tax and healthcare issues. This morning, I'm going to cover two of those priorities, retirement and healthcare policy. It's clear that we need to improve our retirement system. The system hasn't kept pace with changes in the economy, changes in the workforce conditions, or with changes in the retirement environment. We need to expand access and participation in retirement plans, particularly for smaller businesses. We also need to expand the system to bring in independent workers and people who work in the so-called on-demand economy. At the same time, we need to make sure that workers can transition smoothly into retirement. We need to ensure that we have access to savings, that these people have access to savings that they have worked so hard to put aside for retirement. Recent studies now show that a substantial percentage of workers don't have access to retirement savings programs. These studies show that the gap in access is frequently the result of relatively small number of retirement programs offered particularly by small businesses. A recent study by the Pew Charitable Trust found that 40% of the workers in smaller businesses do not have access to retirement savings programs. The Federal Reserve Board's most recent survey of consumer finances found a similar gap in access to those plans. The reasons for these findings are really quite simple when you get down into the weeds. Smaller employers face challenges in helping their workers save for retirement. These barriers include complex rules and high costs. Offering a retirement plan can be a very time-consuming and sometimes a difficult process, not only in terms of establishing those plans, but maintaining those plans on an annual basis. As a result then, as you can expect, many smaller employers shy away from setting up plans altogether. And the resulting lack of access to a plan makes it tough for workers in these smaller companies to save enough for retirement. That's why earlier this month, I introduced the bipartisan Retirement Enhancing and Savings Act of 2019, which typically goes by the nickname of RESA. The centerpiece of the bill is a concept called open multiple employer plans, or open MEPs for short. The bill would expand the existing multiple employer plans to create open MEP plans, which will allow unrelated employers to join together to sponsor a group retirement plan for anybody that wants to join it. The open MEP's improvements will remove regulatory barriers that have blocked the use of these plans. Example, under current law, only businesses that have a significant common interest are allowed to set up a multiple employer plan. RESA eliminates this common bound, a requirement that requires, it ends a requirement by ending the common bound requirement to permit, within limits, more companies to band together and to work with a third-party plan administrator to offer retirement savings opportunities to their workers through this open MEPs. As a result of these reforms, the third-party administrator would have to accept the fiduciary responsibility for operating the group plan. This will continue to protect workers participating, but it will also allow small businesses that join open MEPs to share part of their fiduciary responsibilities with the plan administrator, which will help reduce costs and ought to encourage participation. RESA also eliminates the so-called one bad apple rule. Under this rule, if one employer within a multiple employer plan fails to meet any one of the rules governing these plans, then the entire MEP can be disqualified. This is true even if the other employers are fully compliant. It's easy to see why, then, that this sort of provision can discourage businesses from adopting these kinds of retirement plans, and why this rule needs to be changed. These common sense changes would make it far more feasible for businesses of all sizes to offer retirement plans by harnessing economies of scale and reducing unnecessary administrative burdens. More importantly, open MEPs would open the door for millions of Americans to save for their retirement, especially in growing sectors of the economy. It'll also go a long way towards strengthening retirement security if an online platform company offers retirement plans that all of its independent workers can join. RISA also will help retirees better manage their income in retirement by allowing them to transfer certain types of savings, including annuity products, without violating distribution rules. This will make annuities and other similar lifetime income options then much more popular. RISA is budget neutral from a fiscal perspective, and I know all of you don't think that we take that into consideration enough in Washington with the budget deficits we have, but we've worked hard to make sure that this bill is budget neutral. The main offsetting provision involves an option under current law, often referred to as the stretch IRA. This option allows a person to pass along an IRA or 401k account to a family member or other beneficiaries, with the recipient able to keep the inherited funds in a tax-deferred account. This allows the beneficiaries to continue saving for their own retirement so long as they take out a required minimum amount. RISA would continue the stretch IRA option within a limit on the size of an account that would qualify for continued tax-favored retirement savings for the beneficiary. For example, a daughter could still inherit up to $400,000 in an IRA from her mother and continue holding the IRA for the daughter's retirement much years later. This is a sound approach to funding the bill. It continues to encourage the next generation to save for retirement while ensuring that retirement security changes in this bill are fiscally responsible. Retirement security is an important topic that's already getting lots of attention this year in Washington. The House Ways and Means Committee considered a retirement savings bill, will consider such a bill earlier this month in committee that's based upon the RISA bill that I told you that I introduced. So then that requires bicameralism. I look forward then working with the chairman of the Ways and Means Committee, that's Chairman Neely of Massachusetts, to reconcile our bills and get a final package to the president's desk. As important as the provisions of RISA are for improving our retirement system, we also know that there's more to be done. There's senators like Republican Senator Portman, Democrat Senator Cardin that have other ideas going beyond this that I think are going to be well received. That comes up at another time. You know, we live in a dynamic economy. As that economy evolves, so do the retirement needs of workers and employers. That's why I'm looking forward to the next round of pension reform. As the economy does continue to grow and evolve, our retirement systems need to keep pace with greater access for employees and independent workers and efforts to make our retirees enjoy a financially secure retirement. We have some good ideas for next steps, as I've already alluded to, but we need your help. Your companies manage these plans. You know the market, and you know what works, and you know what doesn't work. I need to know about your ideas. So let's work together. Now, a little more on another subject, but a shorter message on this one, and that would deal with drug pricing. I've heard from people all over Iowa about high prescription drug prices. I've heard stories of people leaving their prescription drugs at the drugstore counter or rationing their insulin in order to make ends meet. Both of these are prescriptions for very bad health care outcomes, costing a whole lot more wherever they end up in the health care system because they didn't take their pills. I've said it's time for us to talk turkey with Big Pharma and the pharmacy benefit managers about the factors that contribute to high prescription drug prices. As chairman of this committee, I've held 3 hearings about drug prices this year. Now, after doing our homework, we're going to be writing legislation to address some of the systemic problems that make prescription drugs unaffordable for some Americans. I expect that legislation to be ready for introduction mid-June of this year. I'll also be working with Senator Alexander of Tennessee, who's on another committee that has some health-related issues as well, and we would hope to put those from both committees together as a package, and approximately in mid-June, as I just said. I also plan to continue to target ways that our system of keeping generics off of the market are gamed. Last week, President Trump signed legislation that I wrote with Democratic Senator Ron Wyden of Oregon, called the Right Rebate Act. Closes one loophole abused by pharmaceutical companies in the Medicaid program. My investigation into the high cost of EpiPens was an impetus for that law. During the investigation, we found one company ripped off taxpayers to the tune of $1.6 billion for just that one drug. HHS didn't properly police the rebate schemes, and Right Rebate corrects those failures. Other legislation to eliminate schemes that keep generics off the market would include the CREATES Act, that's an acronym, which would address anti-competitive practices used by some brand pharmaceutical companies to block entry of lower-cost generic drugs. These brand companies abuse the FDA safety process by denying generic companies access to samples of branded drug products and refusing then to allow them to participate in the FDA-approved safety protocol. The CREATES Act will allow generic companies to purchase samples they need in order to gain FDA approval for generic versions of the brand name drug, and do it much faster than if they went through the usual process. The bill will also give FDA more discretion to approve alternative safety protocols. Then we also have the Preserve Access to Affordable Generics and Biosimilars as another bill that I've co-sponsored to stop the practice of payoff agreements to delay the introduction of cheaper generic alternatives into the market. And I just read you a long name of that bill. I would rather say it stops the pay-for-delay scheme that goes on between brand name companies and generics. When a brand and generic drug companies enter into these anti-competitive agreements, the prices of these medications stay high at what you might call the patent level of pricing, even after the patent runs out. This bill would help to ensure that drug competition can occur as soon as possible. I will continue my oversight of the healthcare system, both government and generics and private entities. This oversight work will inform future legislation, because this business of transparency in the pricing of drug prices, so you got more transparency so that the marketplace will work better. Transparency brings accountability. It ought to end up benefiting the consumer, and we're just starting with prescription drug prices. We believe that there ought to be more transparency throughout the healthcare system, whether it's hospitals, doctors, or anybody else in the system, so that you have an opportunity to know something's going to cost before you actually do it. I thank you for this opportunity to talk to you, and now I'm happy to take questions, and I was told that you wanted me to answer questions, so let's do that right now then.
We're kind of doing the same drill. We've got one Senator Grassley, and just so you're aware, the senator said he knows you're an insurance crowd, but you're more than welcome to ask any question that's not insurance or financial services related. So the first one, Senator Grassley, was just a question around the status of trade negotiations and what you can share about that.
We've got 3 or 4 negotiations going on. Did they say which one, or they wanted a response on all of them?
It was general, so I think you can field the question how you see fit, sir.
Well, I really got to talk in different ways about different ones. With Europe not starting yet, I don't think we're going to have negotiations with Europe on trade issues for the reason, as I met with the EU trade minister, and she insisted that Europe was not going to negotiate agriculture. I said, well, how do you expect us to do that, particularly me from Iowa, that we aren't going to negotiate agriculture? Besides the practical effect, you get an agreement, and most of these free trade agreements that we have, it usually takes agriculture as a locomotive to bring along manufacturing and the services that you folks are interested in doing globally. So I don't see that we're going to be able to negotiate. But now, since the president pulled us out of the Trans-Pacific Partnership, and you shouldn't be surprised he did that. I disagree with he shouldn't have done it, but he told us in the election he was going to do it. And there's one thing about this president, if you don't like what he does, you shouldn't be surprised he did it, because he told all of us before the election what he was going to do, and he seems to be carrying that stuff out. So anyway, he pulled us out of TPP, and that hurt Iowa agriculture primarily, but it probably hurt our pharmaceuticals, probably hurt our services as well. Great gains made for the United States with some of those 11 or 12 countries, but the biggest loss was with Japan, particularly in agriculture, but some other things as well. So we're starting negotiations with Japan this month. Maybe next month they actually start. And if we can get a bilateral agreement with Japan, it'll take care of 90% of the loss that we had of pulling out of TPP. Then we have the U.S.-Mexico-Canada agreement taking the place of NAFTA. Just as soon as we get the president to take off steel and aluminum negotiations, we can get that through Canada, the United States, and Mexico, I think, fairly easy. Canada's ready to jump now, but they won't jump until those tariffs go off. And it's got to be done in Canada before June, because they adjourn in June for their election in October. And if this stuff isn't all done with Canada and Mexico this year, it surely isn't going to be done next year in a presidential election year here. So we have these sort of conversations with the president in the cabinet room about a month ago. The president, there's a lot of discussion about tariffs generally, but eventually you get down to when are you going to take the tariffs off of Mexico and Canada so we can get this agreement even through the United States Congress. And so something like he put the tariffs on because Mexico and Canada wasn't negotiating, and they've negotiated now. He said he has a good agreement. I agree it's a good agreement. So then you ask the president, you put them on because of they weren't negotiating? You got a good agreement? Don't you think they should come off? And he answered me, no. So what do? You know, then Peter Navarro, one of these protectionists in the White House, joins in and he says, you can't conflate the agreement with the tariffs. What do you mean you can't conflate agreement with the tariffs? They were conflated when you started this whole process going. So, you know, none of this stuff really adds up. But he knows they got to come off, and they better come off pretty soon. Then you got China. I think we're about 2 more weeks of negotiation, have an agreement with China. Sign late May or June. And a lot of things to be accomplished. I can't speak for services like you folks are involved in, but I can speak for they're already back in the market on the agricultural products. They got hurt as a result of the tariffs. We're trying to accomplish what we call structural change, quit stealing our intellectual property, our trade secrets, don't have a condition for doing business in China, that you got to give up all your technology and do away with the currency manipulation that you have for the yuan. And you can do everything in the data cloud over here, but we can't do anything in China. We got to get that level playing field. I think those things are being worked out. The last thing to be worked out is enforcement, because we know we had an agreement with China 2011. They didn't carry it out. So what good does it do to brag about all these 5 or 6 things that we're making great progress on that are structural if we don't have enforcement? So that's the last thing to be negotiated. And I assume enforcement's going to be that when China shows the United States and the United States shows China that we're good faith following this agreement, that these tariffs are going to go off in tranches throughout the next, hopefully just the next few months, not a matter of years, because these tariffs are well, they're too protectionist. Does that answer your question?
It does. It was. We were going to hit you with a follow-up. There was a follow-up question about China, and the rumor mill is that you might know the ambassador there. So it's great that you addressed that. So
there's a lot of Iowans know the ambassador there.
So a question about affordable care. There's a standstill on the federal side with the Affordable Care Act. What should states be doing from a legislative and regulatory perspective, given the situation in Washington?
You're talking about the states, what they can do?
From the healthcare side.
Yeah. Well, it seems to me that you're pretty restricted to what you can do as long as Republicans didn't carry out our campaign promise to repeal and replace, and that was because Senator McCain didn't vote with us. You're pretty much locked in to whatever Obamacare allows under those 4 things of platinum, bronze, et cetera, except for what the president can do within Obamacare. And remember, there's 1,693 delegations of authority for the president to write regulations. So obviously, Obama took advantage of that to write Obamacare with more concentration of power in Washington, D.C. Just like 535 of us have all the brains, and we know more than what you 310 million people in the United States know. And we're going to tell you exactly how to do it because you're too stupid to do it. Now, I don't buy that philosophy, but that's the basis for how you're locked into it. So unless the courts declare it unconstitutional, I doubt if you're going to see Chief Justice Roberts change his mind, but if they did, then we have an opportunity to legislate. Now, this president, in just a few ways, and maybe there's more ways he's thinking about doing it, and I don't know what the global possibility is out there, but he's trying to create an environment within Obamacare. And I suppose doing away with the individual mandate helps do this. But it's kind of like this. These 310 million Americans ought to buy what kind of insurance they think they need to meet their needs, and a company ought to be able to sell that insurance to them. And we ought to have more competition. You know, Obamacare was supposed to bring more competition. We had 8 insurance companies in Iowa before it went into effect. Last year we had 1. This year I think we got 2. So you lose competition. Your premiums didn't go down $2,500. If you like your insurance company, you can keep it. If you like your doctor, you can keep it. Millions of people have had to change. All of those things were misled to sell something. Maybe they were made in good faith, but they sure haven't worked out that way. So the Affordable Care Act has become the Unaffordable Care Act for most people. So the president's trying to change things with flexibility through association health plans, through 3 years instead of 3 months of the short-term insurance plan that a person can buy, selling insurance across state lines, stuff like that. And that's about anything that's going to get done in that area. There's a lot of bills I'd vote for, but I doubt if they'll ever be brought up that we could change Obamacare.
This is a fun one. So the Democrats have the House, Republicans have the Senate. We're in a presidential election cycle. There's a lot of political rhetoric. How is the nation going to make any progress given kind of the situation with bipartisanship or the lack of it?
How do you make any progress? Is that your question?
Yep.
Because of the political divide?
Yep, exactly. Yep.
Okay. Well, don't forget, in the Senate, the institution itself drives bipartisan results, because with 53 Republican senators and 60 vote requirement in the United States Senate, except now for appointments, you got to have bipartisanship or nothing's going to get done. Unlike the House of Representatives, where the majority, whether it's Republican or Democrat, if they stick together, they can ignore the minority, but we can't ignore the minority. So I think you get, well, first of all, there is too much partisanship. But within too much partisanship, there's not as much as you think, because controversy makes news. So let's just use the committee that I chaired the last 4 years, Judiciary. So when you're talking about judges, it's the Democrats are on this side and the Republicans are on this side, and very little cooperation. And so that makes the news all the time. Just think of the 6 weeks or 2 months of news about Kavanaugh when I was chairing that committee, or chairing that nomination. Then look at the legislation out of our committee in 4 years. 61 bills got out of committee. They were all bipartisan bills. And 45 of them got through the United States Senate. 34 of them were signed by either a Republican or Democrat president. One of them, the biggest change of sentencing reform in a generation, had 87 people vote for it and 12 against it. You never even hear about that because there's no controversy. Well, I mean, it was kind of a controversial piece of legislation, but it was all within the Republican Party. And so you get a distorted view of it. I can't think of a single senator I dislike, and if somebody dislikes me, I don't even want to know who it is. And so if the attitude is out there, I guess the bottom line answer to your question has to be, it's got to start with each senator working with other people. That's about the best answer I can give you. How do you eat 10,000 marshmallows one at a time? How do you get things done? Talking to one senator at a time to get things done.
I think, Senator, we've exhausted our questions. I don't know if you have any closing remarks, but.
Yeah. Just in case you folks might not think in terms of value to the whole governmental process, I guess then I would refer from that point on that you are valuable from people that say to me, you know, I have 8 15-minute appointments between 3 and 5 each Monday through Thursday. I'm in Washington, D.C. And so at the end of a lot of these meetings, somebody, good Iowan, would say to me, I want to be a resource for you. And I said, if you want to be a resource for me, don't wait for me to call you, you call me. So if you want to be a part of the legislative process, it seems to me that you want to be aggressive in letting your elected officials in Washington, D.C. know what you think about this or that, or maybe just some basic information they need. And you may think that that's not really something that you got a right to do or anything. Remember the First Amendment. And when you think of the First Amendment, you always think of religion, press, and speech. But there's a fourth First Amendment, the right to petition your government for a redress of grievances. That means that you got a constitutional right to talk to those of us that are elected officials And we got a constitutional responsibility to consider your point of view. Now, somebody of you might think that we got a constitutional responsibility to do just exactly what you tell us to do. It doesn't go quite that far. But communication, dialogue between those of us elected and the people we serve is the essence of representative government. If you believe in representative government, you folks have to participate in it. Don't just sit back and wait for us to come to you.
Well, Senator Grassley, we know how busy your schedule is, and we greatly appreciate your willingness to participate today and speak to us.
Good to see you.
Well, the Senator's remarks closes down our symposium for this year. There's a couple of housekeeping items. At the table, there's actually a voucher for $15, and you can use it at the restaurants that are noted on the back, one of which is the restaurant at the airport. So you can use it for food and drink, but non-alcoholic drinks. So there'll also be shuttles outside to pick you up and take you if you need that. So thank you very much. I'll turn it over to Nate.
Yeah, thank you. If you guys have ideas for speakers or topics, please reach out to me, LinkedIn, send me an email, let me know. We're always looking for new ideas and other ideas. Thank you for coming, thank you for attending, and we hope you found it valuable. Thanks.